is talking about your levy of customs. The charging section of customs happens to be a section 12, but along with this charging section we'll be seeing certain special sections as well. The first of those sections would be a special charging section being section 20 and section 21. Clarification to charging section being section 20 and 21. Then exception to the charging section where you'll find certain different concepts there. Levy will be there, but collection will not be there or will be at a lesser value. Pilferage loss, section 13. Abatement for damaged goods, situated goods, section 22. Remission, when you talk about your lost or destroyed goods, 23.1. Relinquishment, section 23.2. Denaturing, section 24. And finally, we will be touching even your refund in section 26A. But that would be finally when we are done with all these points. So basically focusing on your levy part, section 12, read along with your section 20 and 21. Now what is section 12 telling? Only 3 P's. Unlike your GST, customs requires only 3 P's. Product, process, place. Product, process, place. Product should be goods. Product should be goods. Processes your import of goods or your export of goods. Process is either import or export. Place happens to be your India. Place happens to be your India. Even for customs, though India is defined to include TWA, as per Supreme Court judgment, you have to read it as EZ up to 200 nautical miles. Up to 200 nautical miles. So, product, process and place. Product, process and place. Goods imported in India or goods exported from India. Goods exported from India. The moment you satisfy all these 3, you will be covered by your charging section, section 12, and you have to pay a duty which is there under Customs Tariff Act. What is the normal duty that you end up paying? If at all it is import duty, we have been discussing for long time, it is BCD plus SWS plus IGST. Export duty first of all is very rare, but there. Very rare, but there. The concept is destination based consumption tax. So normally there will not be any export duty. But whenever it is there, it is only and only BCD. It is only and only BCD. Import duty, whenever it is there, it is BCD, SWS, IGST. Special import duties may also be there, but these are all normal import duties. Whenever I tell IGST, if it is having compensation cess, it will be IGST plus compensation cess. But for export, understand that normally export duty will never be there. If at all it is there in rarest of the rare case, it will be only BCD. It will be only BCD. Now, talking about calculation of your customs duty, you require assessable value and you require rate of tax. Unlike GST, in customs valuation, we will be seeing that assessable value can either be your transaction value, section 14.1, that was section 15, here it is section 14.1, or it can be for notified goods by central government. It can be tariff value. Goods notified will be by central government, but tariff value will be given by CBIC. So here, either normally it is transaction value, but for notified goods by central government, it will be tariff value which is given by CBIC. So it is either transaction value or tariff value. Rate of duty. As I said that if it is import, there will be import duty, for which you have to refer to first schedule of Customs Tariff Act 1975. If it is export, you may have export duty, very rare, but you may have second schedule of Customs Tariff Act. Customs Tariff Act second schedule will have very few goods because export duties are on very few goods. Rather, government, when they will try to have export duty on goods, either the item is very scarce. Actually, main reason is the item is very scarce in India. Scarce in India, or for some reasons they want to have that, create that demand. For some reasons, maybe macroeconomics level, they might plan something and they might do something. Very rare scenario, it will be that, right? Export duty. Whenever you have import duty will have two rates, which is very special only in customs. One item will have corresponding two rates. One is called as standard rate and one is called as preferential rate. One is called as standard rate, one is called as, so one item, say item X will have 10% as well as say 7.5%. Now you may be confused which rate to select. If you are importing from your most favored nation, what is most favored nation? If you are importing from your most favored nation, which means member nations of World Trade Organization plus countries with which you have bilateral agreement, then you will go with lesser rate, preferential rate. But if your import is not from most favored nation, you will go with higher rate. In rough understanding, friendly nations, enemy nations. Roughly, don't use these terms. Friendly nations, enemy nations. The technical word is most favored nation, preferential rate, other countries, if you are importing from other countries, standard rate, which is the higher rate, So this is the main charging section that you have, section 12. Now, exception to charging section. One exception talks about your reimportation. See, exception, both the exceptions focuses only on one thing, imports. Exception is focusing only on revenue, imports. Section 20 talks about reimportation. What is happening? The goods are re-imported after exportation. You exported it, now you are bringing it back. You exported it, now you are bringing it back. So that is re-importation of goods in India. There was an export, again there is an import. They are trying to clarify that though it is re-importation, we are going to charge customs duty. It will be treated as new imports, fresh imports. We will not give them any relaxation. But having said so, there are exemptions. There are exemptions for re-importation which are quite often asked. There are relaxations. There are exemptions for re-importation. But prima facie levy tells that if it is re-importation, default thumb rule is treated as new imports. We will tax it. The next category is your section 21, which again only talks about import, but it talks about special items, be it derelict, jetsam, flotsam and wreck. Now what is derelict, jetsam, flotsam and wreck? Derelict means a vessel or the cargo inside the vessel which is abandoned in the sea without any hope of recovery. Basically, it is the vessel along with the cargo. It is not cargo and vessel, it is vessel and the cargo. Vessel and the goods inside the vessel which is abandoned without any hope of recovery. Now, what is wreck? A vessel which is damaged and now it is drifting along with the cargo. A Titanic kind of situation. The vessel which has been damaged, now it is drifting inside this sea and coming to the shore along with the cargo. One is abandoned, one is damaged or destroyed. And in this case, they talk about both vessel and the goods inside the vessel, that is cargo. But what is jetsam and flotsam? First, you need to understand jetsam, then you will understand flotsam. Jetsam means the cargo, only goods which are jettisoned or thrown away from the vessel in order to save the vessel from sinking. Few cargo will get sunk and they are not abandoned. They are thrown. At times they will mark it. Okay, this is the area where we have thrown it. So next time when we come with other tools or equipments, we will try to take it away. So that is jetsam. You are thrown inside and they go deep inside and they are not going to float. What is flotsam? Flotsam is also those items that you have thrown from the vessel because to save the vessel from sinking. But the difference is they will be floating and they will be automatically, both are not abandoned. Whether it is Jetsam or whether it is Floatsam, you are not abandoning. As of now, you are throwing it. Rather, it is easier to find your Jetsam rather than find Floatsam, because Jettition goods, those who are going inside and sinking inside the sea, you can easily find it out. But Floatsam, you will be throwing it and it will change place. Difficult to find out unless there is a tracking. Maybe nowadays you can put a tracking device and through, which is now done by all the shipping companies. All the shipping companies, whenever they are throwing any goods, they put a tracker. If it is working well and fine, then they may be able to track it. So that is Jetsam and Floatsam. The focus is only on cargo. Now, why this is discussed in section 21? Whether it is derelict, wreck, Jetsam or Floatsam, look at the language. Whether they are brought or coming automatically. Whether they are brought or coming automatically in India, they will be taxed. They will be taxed. So proper officer will deal as if they are being imported unless there is an exemption. They will be taxed. If nobody is coming and claiming the ownership, you might ask, who's going to pay the tax? If someone tells it is my goods, tax will be collected from that person. Finally, there will be a question comes. Okay, if no one is claiming the ownership will go to the Government of India, Customs Department. If no one is coming forward, in spite of the advertisements given by the Government of India telling that these goods are coming from so and so vessel that we have found out, and if at all you are the owner, bring along with the corresponding documents. If you are coming, you have to pay the duty. No one comes, the goods will go in the treasure of Customs Department. Customs Department. They don't want to leave an opportunity. They are just telling that whether it is re-importation, pay import duty. Whether it is Jetsam, Floatsam, derelict, direct, pay import duty. Pay import duty. These are mere clarification. Section 20 and 21, even they were not there, even then import was happening, even then payment would have been done. But they are very cautious and giving these clarification that whether it is re-importation or whether it is Jetsam, Floatsam, derelict, direct, which is brought or coming, automatically we will collect import duty. We will collect import duty. Now, what is left out here is your section 20, re-importation. Re-importation has got a relaxation. Re-importation has got a relaxation. There are basically two exemption notification. Exemption notification 45 bar 2017 and exemption notification 158 bar 95. There are two exemption notifications. So if you are covered in these two exemption notification, either there will be partial exemption or there will be full exemption. Re-importation is happening. Re-importation is happening. Let us see these exemption notification. In this first exemption notification 45 bar 2017, there are three situations or three scenarios. There are in totality three situations or three scenarios. Three situations or three scenarios. What is the first scenario? You are talking about a case where goods were exported under the claim of duty drawback, which is a provision of customs, or refund of IGST paid on export, which is a provision of GST, or bond or LUT without payment of IGST and then claiming the refund of unutilized ITC, which is again a benefit provision in GST, or duty exemption scheme, which is advance authorization or duty free, export promotion capital goods scheme, which is a benefit of foreign trade policy. You have exported goods taking export benefits, be it customs benefits or GST benefits or foreign trade policy benefits or combination of all. So you have taken the benefit under customs law. You have taken the benefit of exports, be it under any law. Now what is happening? The goods are re-imported. The goods are re-imported. Now look at the way re-importation should happen. The time limit for re-importation is 3 years plus 2 years extension. The exported goods and the imported goods should be the same. The exported goods and the imported goods should be the same. If at all the goods are sent for repairs, ownership should not have been changed. Simple language. Goods should be the same. Owner should be the same. Time limit is 3 plus 2 years. Goods should not change. Owner should not change. The person who has sent it, only that person has to receive it. At times I will be sending the goods because of repairs. When I am getting it, I should be the same person, importer. And finally, the time limit to bring back the goods. The goods went outside. If you want to take the benefit here, you have to bring it back within 3 plus 2 years. 3 plus, these conditions are not only for first situation, they are for all the three situations. Therefore, all the three situations. What is the benefit for the first situation? Let us only first focus on the first situation. What is the benefit? You are required to pay a duty which is lower of actual import duty or export benefit that you took at the time of export. You have to pay import duty. If the actual import duty is 1 lakh and export benefit you took at the time of export is 80,000, how much you will pay? 80,000. If actual import duty is 1 lakh, if export benefits that you took at the time of export is 1,20,000, how much you will pay? 1 lakh, whichever is lower. If actual import duty is 1 lakh, if you never took any export benefits, how much import duty will pay? 0. What is the answer? Actual import duty or export benefit, whichever is lower. So in the third case, I said actual import duty is 1 lakh. At the time of export, you did not take any export benefit. You did not take any export benefit. So 1 lakh or 0, whichever is lower. Understand that whichever is lower is the duty payment. Is the duty payment. So what you are going to pay is 0. So what is exempted is fully exempted. What is exempted is? Go back to the first example. Actual import duty is 1 lakh. Export benefits taken at the time of export is 80,000. How much you are going to pay? 80,000. What does it mean? 20,000 is exempted. 20,000 is? Second example, no exemption. Actual import duty is 1 lakh. Export benefit was 1 lakh 20. How much you will pay? Entire 1 lakh. No exemption. So you will find all the three cases. Full exemption, partial exemption, no exemption. By applying this, you may be covered under any of them. So what is the duty payment that you make? Actual import duty or export incentive at the time of export, whichever is. Actual import duty at the time of reimportation. Export incentive at the time of exportation, whichever is lower. Whichever is. This is not exemption, this is duty payment. This is not exemption, this is. And if you compare finally, you might find what is exempted. This is duty payment. Now what is the second scenario? Second scenario is the goods are exported without any export benefits for repairs. For mere repairs. For mere repairs. This should not amount to remanufacturing or reprocessing by melting, recycling or recasting. Mere processing, not amounting to remanufacturing, reprocessing, melting, recycling or recasting. Now understand the scenario. Okay, if I were to explain this first situation in a very simple way, there was sale and there is sale return. There was sale, export, and there is sale return, re-import. In the second situation, initially there was import. A very important point that ICI has asked repeatedly, second part. Rather, in the entire chapter, if I would tell that what is the most important area in this entire chapter, it is the second point here. So what has happened? You have purchased the goods imported in India. Now you are sending the goods for repairs. Sending the goods for, not selling it. Sending the goods for repairs, which is re-exportation or exportation. And again you will be bringing back the goods where there is re-importation. Where there is re-importation. Where there is re-importation. You imported the goods, paid import duty. You are exporting it and it is clearly mentioned that you should not take the benefit of exports. Now you are re-importing it. Should you pay import duty is the question. Already you imported the goods, already you paid import duty. You had sent it for repairs, not for manufacturing, remanufacturing, reprocessing, recasting, recycling, remelting. Only for mere repairs. Now it is coming back. If you see this entire chain, already you have paid import duty. Should you again pay import duty? Should you again pay import duty? Yes, you are required to pay import duty again, but the value for import duty. Now it is not import duty calculation. It is value for import duty. That you will multiply it with import duty rate. The value will be whatever value additions are done outside India. Supposing the machinery value was 1 crore. You imported for 1 crore. You already paid import duty on 1 crore. You send it for repairs. You bring it back. At the time of bringing it back, on what value you will pay? You will not pay import duty again on 1 crore. You will pay on the freight and insurance charges from India to outside India. The freight and insurance charges from outside India to India. The cost of repairs and the cost of materials used in repairs outside India. Whatever is happening outside India. Whatever is happening, but I'll be sending it first. Freight insurance from India to USA. There'll be repairs, fair value of repairs, including the cost of materials used in repairs. Again, it will be coming back. Freight and insurance from USA to India. That will be the value. Is this the tax amount? No, this is not the tax amount. This is value. This is value. Then use the customs duty rate and pay the duty. Customs duty rate will be that of machinery only, not of services. It will be that of machinery, but value is reduced. Why it is reduced? You are not going to pay import duty again on entire 1 crore. You imported the machinery. You have already paid the import duty on 1 crore. Now there is a problem with machinery. You are sending it for repairs. You are bringing it back after the repairs are over. After the repairs are over. So if at all you are asked to pay again import duty on 1 crore, it will not be fair. Therefore, they tell that, okay, you have to pay import duty, but on what value? Freight and insurance from India to outside India to India. In outside India, what was happening? Repairs. So take the fair value of the repairs, including cost of the materials used in repairs. Even if the repair is done free of cost, you have to take the fair value. Even if the repair is done free of cost, you have to take the fair value of cost. So that is given here. Here this note is mentioned whether or not such costs are incurred, which means even if it is done free for customs duty purposes, you have to add all these. You have to add all these and pay import duty. And the last scenario here, what is happening in the last scenario? Last scenario, you have sent the goods for exhibition. You have sent the goods for exhibition, export. You are not selling the goods. You have sent the goods for exhibition, export. After exhibition is over, what you will do? You will bring it back. You will bring it back to India, re-import. Now, when you send the goods for exhibition, obviously you will not take any export benefits. When you bring it back, just think logically, whether there should be any import duty? No. There won't be any import duty. There won't be any import duty. There won't be any. India also wants their businessmen to make presence felt outside India. So they'll also promote their businessmen to go outside and display their goods. And that will finally result into export order. As of now, you're taking for exhibition, showing them. If they like it, they'll purchase it. Then that is export. That will never be brought back. What will be brought back, by the way? If you take 100 units outside, 20 units are sold there. Are we concerned with 20 units? No. Our concern is with 80 units. No need of paying import duty. But for all these three, if you see the scenarios now, what was the first scenario? Sale, sale return. Export, re-import. Second scenario, purchase, that is import. Send it back for repairs, export, and bring it back after repairs, re-import. Third scenario, sending for exhibition, export, bring it back after exhibition is over, re-import. In the first scenario, they talk about what? They talk about what will be the duty. What will be the duty? Lower of actual import duty or export benefits. In the second scenario, they don't talk about duty, they talk about what will be the value. What will be the value? Whatever is happening outside India will be the value. In the third scenario, they tell that, okay, it is fully exempted. It is fully exempted. But please understand that whether it is situation 1, 2 or 3, there are common conditions. What are the common conditions? The moment it is going outside, it should come back within 3 years plus 2 years extension. Owner should remain the same. Goods should remain the same. Owner should remain the same. Goods should remain the same. And any of these three benefits, whatever exemption we have discussed will not be applicable in all these cases. Whatever three exemptions we have discussed will not be applicable in these cases. What are these cases? If at all the goods was exported by EOU or a free trade zone, not FTP, a free trade zone, which includes SEZ, a free trade zone. If at all the goods were exported by EOU or a free trade zone, or if the goods were imported and exported by, exported by public warehouse or private warehouse, or if you're talking about petroleum and tobacco products, which is there in 4th schedule of your Central Excise Act. Central Excise Act is no more there, but excise is still there on certain items. Back to basics. Your Central Excise duty is still there on certain items. Recollect those items. Recollect those items. Permanently outside GST, liquor. There you don't have Central Excise duty. Temporarily outside GST, 5. So you have petroleum products. Excise will be there. Then inside as well as outside GST, tobacco. So you are talking about your petroleum products and tobacco products where Central Excise duties are. Where? So they are demotivating re-import of petroleum and tobacco products. They don't want re-import of tobacco and petroleum. The logic of telling that the benefit will not be given for tobacco and petroleum products is they don't want re-import of tobacco and petroleum products. But what is the logic of first 2 points? When the goods are exported by your EOU or special economic zone, or goods are exported from public warehouse or private warehouse, first time import duty was never paid. There's no need of any relaxation. See, when they are exporting, they would have imported earlier. They are all tax free. They got the goods tax free. I'll give a practical scenario to make you understand this. I have a unit in SEZ as well as domestic tariff area. Initially, the goods were imported in SEZ. No import duty. It is exempted. The goods were sent back. Second time when the same item was imported, it was imported by domestic tariff area. Should I pay import duty? Yes. Fully? Yes. Any of these exemption? No. Another example. Initially, I imported the goods and kept in public warehouse and private warehouse. Did I pay the duty? No. Did I clear the goods? No. There was some problem. I had sent it back to outside India. After the work was done, I imported back. This time I did not took the goods to warehouse. I cleared the goods for home consumption. Should I pay import duty? Yes. Full import duty? Yes. Will I be given any exemption? No. There's no need. There's no need for exemption because there was no relaxation earlier. There was no relaxation. There was no duty earlier. Already when first time import was done, there was never any import duty payment. So second time import when it is done, not by them but by other people of the same company, BT of the same company, or now this time cleared for home consumption by the same company, I cannot take the benefit of this exemption. Otherwise, I will be trying to misuse. I will misuse this provision. Right. Now, when you talk about another exemption which is given in 158 bar 95. It is exactly opposite of the second exemption given in 45 bar 2017. Exactly opposite. What was the second situation there? You imported, you send it back for repass, you re-exported, you re-imported. Import, export, re-import. Purchase, send it for repass, bring it back. Here it is ulta. Here what is happening? There was sale, export. The customer outside India said that there's a problem with the product. So, the goods are brought back to India for repairs or remanufacturing. Here, repairs is allowed, even remanufacturing is allowed. So, now it is re-imported. After you correct the mistake, after you do your repairs or after you do your remanufacturing, here both is allowed. There only repairs was allowed, but here repairs is allowed, remanufacturing is allow. You send it back. You send it back. You send it back after repass or remanufacturing. That is re-export. By the way, this situation is there also in your place of supply section 13. Performance based on goods. Exactly the same scenario. Exactly. Ditto the same scenario. When you exported the goods, you would have taken export benefits. You would have taken export benefits. No issues. When you are importing the goods, technically you should pay import duty. Technically you should pay import duty. They tell that don't pay import duty. They tell that don't pay import duty. No need to pay import duty. Why? Even if you pay import duty, when you take the goods back, you will be claiming duty drawback. When you take the goods back, you will be claiming. So don't claim import, don't pay import duty, no need of duty drawback. There is no requirement of you paying import duty, then again going there. In addition to it, if you recollect your GST, place of supply provision, section 13, you are doing some repairs or remanufacturing, you may charge it. Now it is not about goods, import of goods, it is about your repair service or remanufacturing service. Now, place of supply of that in accordance with section 13, 5, which gives back reference to section 13, subsection 2, will be location of recipient, which will be equal to outside India, which means it will be treated as export of services, which means there won't be any IGC. So there is no import duty in customs and there is no GST even for your repair work in GST. Even for your repair work in GST. Ditto same situation was there in your section 13. Copy paste, same situation. You have exported it, now bring it back for doing some repairs or remanufacturing. You do your work and send it back. You do your work and if at all you pay any duty in India, again at the time of export you will be taking the benefit. So don't pay import duty, don't pay GST, no question of duty drawback, no question of refund in GST. No question of refund in nothing. This is the entire concept of your section of your notification 158/95. Just understand this concept of destination based consumption tax was right there from the beginning in indirect taxation. So you are talking about a notification which belongs to the year 1995. The concept was always the same. Now what is happening? What is happening? You have exported your goods which are manufactured in India. There is a problem with the goods. There is a problem with the goods. The goods are re-imported. Re-importation can be for repairs, reconditioning, basic work. It can also be for reprocessing, refining, remaking, manufacturing also. Both are covered here. Unlike the previous exemption, now both are covered here. Normal work, full work. Repairs, reconditioning is normal work. Refining, remaking, reprocessing is to redo the entire manufacture. To redo the entire manufacture. All you have to satisfy is you satisfy certain condition. If at all it is for repairs and reconditioning, the goods should have been imported within 3 years. 10 years for Nepal. Special relaxation for sister country. I don't know why Bhutan has left. Normally Nepal and Bhutan comes together, but here it is only Nepal. Think of it. Repairs may take time, but when the product itself was faulty, and when the customer of yours is telling that this item that you have sent is not at all working, you have to remanufacture it. Whether to identify that you require 3 years? No. You re-import within 1 year. Don't try to by heart it. When the goods or machine is going there, if it is functioning, then repairs may come at some later point of time. 3 years, 10 years in case of Nepal. But if you have sent the machinery, the moment you see the machine, there's some fault with the machinery. Whether the customer of yours outside India will take 3 years time, he'll send it immediately. And the time limit is 1 year. And the time limit is, so re-importation is 3 years if it is repairs and 1 year if it is remanufacture. Basic thing. 3 years and 1 year. And when you bring it back, don't you think that you are required to do your work quickly? You are required to do your work quickly. Make sure that whether it is repair or remanufacturing, that is repairs, reconditioning or remaking, refining, reprocessing, do your work within 6 months plus 6 months. For repair, 6 months is sufficient. At time for remanufacturing, you may require an extension, therefore 6 months plus 6 months. After you import, 6 months plus 6 months. And when you re-export, there are certain conditions to be satisfied. You satisfy your assistant commissioner, deputy commissioner that the goods are the same. That the goods are the what was imported is only going out. You prove it. Otherwise, in this process, you will try to some other item, sell some other item. You prove that ACDC that the goods are the same, but understand that when you're basically doing remanufacturing, that is refining, remaking, reprocessing, there may be some loss. Assuming that you exported biscuits, you are re-importing biscuits because they were damaged. Now, when you're remanufacturing it or remaking it, you might not have the exact same quantity that you imported. So, if there is a normal loss, because you have remanufactured it, that will be ignored by ACDC. That will be ignored by ACDC. Now, also understand that as you are promising that you will be exporting in next 6 months plus 6 months, whenever you make a promise, that should be along with the bond. When you re-import, you are getting the benefit of not paying the import duty. But who knows whether you re-export within 6 months plus 6 months. So at the time of re-importation, when you are not paying import duty, give a bond. Give a bond telling that I promise that I'll do my work and send the goods back within 6 months plus 6 months extension. And if this loss point we have discussed, if there is any loss because of reprocessing, refining, remaking, such loss may be exempted. Such loss may be exempted. This point is repeated here also. Such loss may be exempted because the quantity that was imported and the quantity that is going out is very, that's the difference, but the difference is very minimum. And the difference is because of natural manufacturing loss. Right? It is because of normal loss. In your costing language, it is because of normal loss. That will be ignored. That will be ignored. Bring it back within 3 years or 1 year. Send it back in all the cases 6 plus 6. When you are bringing it back, give a bond. When you are sending it back, satisfy ACDC with the identity, and if there is a normal loss, convince ACDC that why this normal loss has come. Convince ACDC why this normal loss has. That is all about your notification 158/95. Now, this completes your normal charging section, section 12, special charging section, section 20 and 21, read along with notification 45/2017, 3 situations, and 158/95, 1 situation. Only 1 situation. Now you are talking about exception to the charging section. Exceptions to the charging section. In this entire chapter, that notification 45/2017, second scenario was very important, and the next important scenario is all these exceptions. All these exceptions, different situations. Section 13 talks about pilferage loss. Pilferage loss. What is pilferage loss? Petty loss. Petty loss. Theft in small quantities. Theft in small quantities. Theft in small quantities. Now, let me produce this in a very different manner. Supposing you're talking about pilferage loss, you're talking about petty thefts. Petty thefts covered in section 13. A comparative term is there in section 23(1). A comparative term is there in your section 23 subsection 1. That's a comparative term. Now, what is that comparative term? You're talking about total loss or major loss. Total loss or major loss. Both are mutually exclusive. If it is petty loss, you can come and take the benefit of only section 13. If it is total loss, major loss, you can only go for section 23 subsection 1. Whereas section 23 subsection 1 talks about one more thing. What is that one more thing? Destruction. What is that one more thing? Destruction. Destruction of goods. And corresponding to destruction, there's something called as deteriorated goods or damaged goods. Deteriorated goods or damaged goods, which is there given in section 22. For deteriorated goods or damaged goods. For deteriorated goods or damaged goods, you go for abatement, which means reducing the value. For total loss, major loss, or for destruction, you go for remission. Begging the department, telling that please forgive me my import. Please forgive my import duty. Then there is something called as relinquishment of title or surrendering the title, which is given in your section 23 subsection 2, read along with section 68. Read along with section 68. Relinquishment of title or surrendering of title. Then finally you have something called as denaturing or mutilation, changing the nature, which is there in section 24. What are comparators? Pilferage loss, total loss, major loss. Pilferage loss means loss in small quantity. Total loss, major loss means it is not in small quantities. It is not in small quantities. It is a major loss. It may not be always total loss, but it should be major loss. It should be, both are mutually exclusive. Either you are covered in 13 or you are covered in 23(1). You are not covered in both. Mutually exclusive. Then other comparative terms: deterioration, damage, destruction. Deterioration, the quality is reduced. Damage, there is a physical damage. Destruction, the goods are not at all that. It is gone. The goods are not at all that. It is gone. Then there is something called as relinquishment of title, giving up the title. The goods will be there, maybe in a good condition or not in a good condition, but you want to give up the title. And finally, a very separate concept called as denaturing or mutilation. Denaturing or mutilation. For petty loss, in all the cases, levy is there. In all the cases, levy is there. In all the cases, you do have levy. You do have levy. Levy is not relaxed anywhere. You do have levy. We are only talking about collection. Our focus is only on whether levy is present in all the cases. Levy is clearly present in all the cases. It's only about collection. In case of pilferage loss, that is petty loss, what will happen? Importer will not pay. On that small loss, supposing 1 lakh units are imported, 100 units are lost. Importer will not pay on 100 units. He'll pay on 99,900 units. Importer will not pay. Custodian may pay. Custodian as appointed as per other laws. Custodian appointed by commissioner. If it is custodian appointed by other laws, say for example, collector is appointed as the custodian, even custodian will not pay. If it is custodian appointed by commissioner, customs commissioner, custodian will pay. So when you talk about your pilferage loss, what was the example? You imported 1 lakh units. You imported and you are clearing 99,900 units. There is no doubt with respect to 99,900 units because you have to pay import duty on 99,900 units. What about 100 units? Importer will not pay. Importer will not pay. Custodian may or may not pay. If custodian is appointed under other law, no. If custodian is appointed by commissioner under Customs Act, yes, custodian will pay on 100 units in the second case. What about damage or deterioration? What about damage or deterioration? Whether there will be payment. Whether there will be payment. Yes. Yes. There will be payment. But there will be payment on a lesser value. Assume that the original value of the goods was 10 lakhs and customs duty. And your customs duty, which is, will take only BCD. BCD at 10%. BCD at 10%. What would have been BCD at 10% by the way? 1 lakh. If value is 10 lakhs, BCD at 10% would have been 1 lakh. Now, you are claiming that the goods are deteriorated or the goods are damaged, which means quality is reduced or there's a physical damage, obviously that also will result into value being decreasing. Now, on that lesser value, assume that the value has become 7 lakhs. You are going to pay the exporter of other country 10 lakhs, but the value of that is only 7 lakhs after deterioration or damage. What to do? What to do? Pay import duty on 7 lakhs, not on 10 lakhs. Not on, what will be the import duty that you will pay? You will not pay 1 lakh, you will pay 70,000. How you got that 70,000? Cross multiplication. Cross multiplication. So they give a formula which is telling that value after damage deterioration divided by value before damage deterioration multiplied by duty before damage deterioration. Cross multiplication. If you get the question directly, you can find out the answer without even seeing the formula. Cross multiplication. Cross multiplication. But you should have a doubt that who will decide this 7 lakhs? Who will decide? The goods are damaged, deteriorated, but who will decide that the goods value has become 7 lakhs? They tell initially that proper officer will decide what is the value. But if you are not satisfied, with the value set by the proper officer, what you can do? What you can do? You can ask the officer to sell the goods by way of public auction, tender, or any other manner with your consent. If proper officer gives you a value which you are not convinced, if proper officer tells that it's 9,50,000 and you are telling that no, there is no only 50,000 reduction is not that. So what do? You tell proper officer, okay, you sell the goods on my behalf. Right? Either by way of public auction, tender, or any other manner. And after you sell the goods, you will get cross sale proceeds. You will get gross sale proceeds that will be taken as this value, not the net sale proceeds. It is the gross sale proceeds because you are trying to find out the worth of the goods at that point of time, at the time of input. Right? That is when you talk about your damage or deterioration, the calculation part. What about total loss or major loss or destruction? Here you will go and beg the assistant commissioner, deputy commissioner, telling that please don't ask any import duty because the goods are already lost or already destroyed. Please don't ask any import duty. You will make a remission application. You will make a remission application to ACDC. And when you make a remission application, you will give the corresponding proofs telling that there is a total loss or major loss of the goods. Say for example, it is destroyed by fire, loss or destroyed by fire. Give the proof. Either the FIR copy or the insurance claim, give the proof. No import duty. What about relinquishment of title? Here also you will not pay any import duty. You will give your title to commissioner. You will go to the commissioner. This time you are not going to go to ACDC. You will go directly to Commissioner of Customs and tell that take this title of goods. Take this ownership of goods. I don't want these goods. I don't want these goods. This title can be given for any reason. You need not explain the reason. There's no requirement for you to tell why you have given up the title. One of the reason for you giving up the title is the market value has tremendously come down, or the goods are deteriorated, or the goods are damaged, or the goods received are not that you have asked for. No, it tells the deterioration, damage is again coming here. Possible. Understand, if you want the goods, you go for abatement under section 22. If you are not interested in goods, you go for relinquishment of title, section 23 to subsection 2 or section 68. You do your cost benefit analysis. Then decide whether to pay lesser import duty and clear the goods for damaged and deteriorated goods, or whether to give up the goods and no question of any payment. No question of any payment. And finally, when you're talking about your denaturing mutilation, you are going to pay import duty on the changed product. On the changed product. If at all you imported second hand machinery, but you are telling the officer that no, I am going to use it as waste and scrap. Officer will tell that no, you imported second hand machinery, pay rate of duty on second hand machinery. But you are telling that no, I am going to use it as waste and scrap. So in front of the officer, destroy or totally de-erect the plant and machinery, convert that into waste and scrap, clear waste and scrap. From custom station, you clear waste and scrap. You do that in front of the officer. That is mutilation. Denaturing. If you bring any liquid item where the nature is different, say for example raw alcohol, and you're telling that no, don't treat it as raw alcohol, don't apply the rate of duty of raw alcohol, apply the rate of duty of industrial alcohol. But officer tells that in front of me, what is that? Raw alcohol. Why should I apply the rate of duty of industrial alcohol, which is a lesser rate? In front of the officer, change the nature of raw alcohol to industrial alcohol. In front of the officer, do that. Then clear industrial alcohol, pay duty on industrial alcohol. Look at this transaction, very special transaction. You imported second hand machinery, but what you are clearing from customs is waste and scrap. Technically speaking, you are liable to pay import duty on second hand machinery, but because of 24, you end up paying duty on waste and scrap. Second example, you imported raw alcohol, but what you are clearing from customs is industrial alcohol. Technically speaking, you have to pay import duty only on raw alcohol, but in front of the officer, you converted that raw alcohol into industrial alcohol. Now you are taking industrial alcohol, you are paying duty on industrial alcohol. That is because of section 24. That is because of section 24. This is the meaning of all these items and the main points of all these items. Are you guys clear with this entire understanding? Right, starting from your pilferage loss to damaged goods, deteriorated goods, for which you will go for abatement, total loss, major loss or destruction, for which you will go for remission, relinquishment of title, then you have denaturing mutilation. I am not writing the sections again, we have already discussed that. Now certain other points. Pilferage loss is your right. You need not tell anything else. You just prove pilferage loss and take the benefit. Importer will tell that I will not pay import duty on 100 units, it is my right. I will not explain it further. Whereas when you talk about damage, deterioration, abatement is not your right, it is based on your request. You will give permission, you will give application to ACDC. Even remission application, total loss, major loss or destruction is based on request, In both the cases, request will go to Assistant Commissioner, Deputy Commissioner. Whereas relinquishment of title is your right. Obviously, you will give intimation to the Commissioner. Intimation, no permission. Intimation to the Commissioner. Denaturing mutilation. Is it your right or request? Is it your right or request? Just like that, in front of the officer, you will go and break the second hand machine into waste and scrap. Just like that, you will enter custom station and convert raw alcohol into industrial alcohol, or it is based on request. It is based on. So only two things are based on your right: pilferage loss and your relinquishment of title. Pilferage loss and your relinquishment of title. Pilferage loss and your relinquishment of title. Now also understand that when you talk about the timeline where these should happen, all these things should happen before you are taking the goods for home consumption. Pilferage loss should happen after unloading of goods, before order of proper officer, either for home consumption or for warehousing under section 46. Before order of proper officer for home consumption or warehousing. Put in simple terms, It should happen at custom station. It should happen at customs station. Customs station. Damage, deterioration. Damage, deterioration. Things are separate for damage and things are separate for deterioration. I'll make life simple. Pilferage loss. Pilferage loss. The place where it should happen is only customs station. If pilferage loss happens at customs warehouse, you will not get any benefit. You have to pay the import duty. You have to pay the import duty. Now, when you talk about damage and deterioration, things are separate for damage and things are separate for deterioration. So, first let us understand deterioration, then let us understand damage. For deterioration, it should happen before even the goods are taken in custom station. Before unloading at custom station. It is neither allowed when it is happening at custom station nor allowed when it is happening at customs warehouse. It should be before unloading. Before unloading at custom station. You will find out that it has happened after unloading. But deterioration should have happened before. See, both are different. Only after unloading you will see that the goods are deteriorated. But that deterioration should have happened before unloading. It should not happen when the goods were at custom station. Why? Do you know the goods are perishable goods? If you keep for some more time, it will be getting deteriorated. So deterioration should happen, which is there without your control. What is not in your control? Before unloading. After unloading, if deterioration happens, it is your mistake. It is your mistake. You came late. Whereas when you talk about damage, or when you talk about remission for total loss, major loss or destruction, or when you talk about relinquishment, or when you talk about your denaturing mutilation, this can happen either at custom station or at customs warehouse. Look at the understanding. Normally, all the benefits are allowed both at customs station or at customs warehouse. Before you are clearing the goods. So you can go for a mission at customs station, even at customs warehouse. You can go for relinquishment at customs station or at customs warehouse. You can go for denaturing mutilation at customs station or at customs warehouse. But when you're talking about damage, you can even go for damage. You can even go for abatement of damage at customs station, at customs warehouse. Even for damage, you can go for customs station or customs warehouse. What is the point which is different? For deterioration, it should be before unloading at customs station. And when you talk about pilferage loss, allowed only at customs station. For deterioration, it should be even before unloading at customs station. You will find after unloading, but it should have happened before unloading at customs station. Pilferage loss should happen only in customs station, not in customs warehouse. All others, abatement for damage, remission for total loss, major loss, remission for destruction, relinquishment of title, denaturing, mutilation, it can happen both at customs station or at customs warehouse before you are taking your goods. That is everything about all these concepts. Now, certain small points, one or two small points. Pilferage loss, if the pilfered goods are again returned back to you, pay import duty. If the lost goods are again returned back to you, pay import duty. The loss, small loss which was there, it is returned back, pay import duty. That is with respect to your pilferage loss. Now, a small point with respect to your relinquishment of title. The benefit of relinquishment of title will not be given if you have committed an offence under any law. The moment you have committed an offence under any law, you will not be allowed to take the benefit of relinquishment of title. The moment you have committed an offence under any law, though it is your right, you cannot tell. If at all you are smuggling the goods and you are caught, you cannot tell that no, you take the goods. Relinquishment of title is not allowed if you have committed an offence under any law. And once the goods are relinquished, you cannot take it back. You don't play games with customs department. Take the goods today, and tomorrow tell that no, please return my goods. No, that's not possible. That's not possible. Right. These are the special points that you need to remember for your, one was for pilferage loss and 2 points were there for your relinquishment of title. Relinquishment of title. So this completes your entire understanding with respect to your levy of customs. Be it section 12, the normal charging section, be it section 20, 21, special charging sections or clarification to charging section, or be it 13, 20, 2, 23, 1, 23, 2, section 68, even your section 24. These are all your special provisions. Now, when you talk about your customs valuation, the entire concept of customs valuation is discussed in your section 14. Section 14.1 talks about your transaction value. And then section 14.2 talks about your tariff value. And remember one thing, whenever you're finding value, this value will be basically used only and only for the purpose of BCD. Then for other duties, the value will not be exactly the same, it will be differing. So this valuation is only and only for BCD. Obviously, it will be helpful for other duties also. The foundation will be this, but most importantly, it will be only for your BCD purposes. So you talk about your two types of valuation. One is your tariff value, which is given by CBIC, which means irrespective of the transaction value that you deal with, whether you are importing for 1 lakh or 1.5 lakhs or 1,20,000, if the tariff value is freezed as 1,30,000, that will be taken as the value. So value for notified goods, will always be only tariff value, which means they'll ignore your transaction value, they'll go with the tariff value given by CBIC. Now before I go ahead, please understand that we'll first try to understand valuation only for import purposes. The moment we complete valuation for import purposes, the very simple differentiation chart is sufficient to make you understand the valuation of export. So our entire focus is to find out value for imported goods. In imported, and the same concept will be there even for export goods with some changes that we'll discuss in the end. So when you talk about valuation, section 14.2 valuation, special valuation is there only for notified goods, where government is not going to see your transaction value. It will tell that whether you import for price X or price Y or price Z, we have said that this is the value. 1,30,000 is the tariff value. You go with 1,30,000. Obviously, for a particular number of units. If the units increases, that will change. Now, what is the normal valuation? Normal valuation in your customs is your transaction valuation. Other than notified goods, it is your transaction valuation. By the way, in GST, you don't have the concept of tariff value. Directly, you have the concept only of transaction value. In customs, main valuation is transaction value, but for notified goods, it can be your tariff value. So let us focus on the main valuation, which is transaction value, For you to be covered under transaction value, you are required to satisfy certain conditions. There are totally section 14, 4 conditions. Section 14, 4 conditions. Rule 3, another 4 conditions. Then you have something called as last 2 conditions, which is your valuation declaration and rejection. So it is 4 plus 4 plus 2. For you to be covered under rule 3, you have to go with 4 plus 4 plus 2 conditions. 4 plus 4 plus 2 conditions. Now, before I take those conditions, understand in GST, if you satisfy the conditions in GST, if you satisfy the conditions. In GST, you have the concept only and only of transaction value. Here you have tariff value at times. Mainly it is transaction value. Mainly it is transaction value. Now we are talking about the differences when it is transaction value. In GST, if you satisfy the three conditions of section 15, then you need not refer valuation rules. Correct? With the three conditions, price is a sole consideration, unrelated party transaction, not a special case. You need not refer to valuation rules. But in customs, how many conditions are there? 4 plus 2 conditions. Even if you satisfy all the conditions, still you have to see valuation rules. Because the main answer in customs is given in terms of rule 3, which is your transaction value. Then it is rule 4, 5, 7, 8, 9. Right. So a clear-cut difference is seen that in GST, if all the conditions are satisfied, there is no need to see valuation rules. Whereas in customs, even if you satisfy all the 10 conditions, 4 plus 2, still you are required to see valuation rules. In GST, if at all you are seeing valuation rules, if at all the conditions are not satisfied, obviously you have to see the valuation rules. You don't apply the rules in sequence. It is either 27 or 28 or 29. Then here you apply the sequence 30, 31. Correct? The rules are not applied in sequence. The rules are applied based on situations. But here the rules are applied in sequence. The rules are applied in sequence. First, you have to try. First, you have to write rule 3. If not, go to rule 4. If not, rule 5. If not, rule 7. If not, rule 8. If not, rule 9. You have to apply the rules in sequence. So always our focus will be first only on the main rule, which is rule 3. Valuation is always under rules. Your valuation is always under rules. Now talking about rule 3. Now what we are trying to understand, rule 3 conditions. How many conditions are there? 4 plus 2. What are the first 4 conditions? What are the first 4 conditions? That should be sale. What are the first 4 conditions? That should be sale transaction. Second, delivery should be at the place of importation. Should be at the place of importation, which means India. At the time of import, where is the place of importation? India. And because of this, your imports are always valued at CIF. Cost plus insurance plus freight, because delivery should be at the place of importation, India. Cost when the goods are sent from outside India, plus insurance and freight when the goods are touching India. When the goods are touching India. Third, buyer and seller should not be related. Should not be. We have discussed the definition of related person of customs, right, when we have seen GST. Related person of GST, make 2 changes. 25% to 5%. Another change in GST, sole agent is by default treated as related person. But here, by default, he is not treated as related person unless otherwise he is covered. Fourth, price is the, so if you see third and fourth, it is the same. It is the same. Unrelated party transaction, price is the sole consideration. What is extra given? The transaction should be that of sale. Because when you talk about import and export, it need not be actually a sale transaction. I can get the goods from outside India as a gift, or I can get the goods from outside India as free samples. or I can get the goods from outside India, acting as an agent of foreign supplier. There is no sale. But here they tell that if you want to come in main rule, rule 3, there should be sale transaction. Delivery should be at place of importation, that is India, unrelated party transaction, and price being the sole consideration. Now, once you satisfy all these 4 conditions, it is not satisfactory. First, you have to satisfy these 4 conditions. Next, you have to satisfy another 4 conditions. What are the another 4 conditions? The sale which is there should be unrestricted sale. There should not be any restriction. What are the first 4 conditions? Sale, place of importation, unrelated, sole consideration. Now, next 4 conditions are given in rule 3. That sale which we are talking about should be unrestricted sale. The sale that we are talking about should be unconditional. It should be unrestricted. It should be unconditional. This is your 5th condition. This is your 6th condition. 7th condition. If there is any subsequent sale proceeds, you should be in a position to quantify what is that amount. If you are going to get partial sale, if at all, as an importer, you are paying one amount now and balance proceeds you will be paying later. You should be able to quantify what is the balance amount that you are going to pay later. Subsequent proceeds should be quantifiable. 8th. Again, they tell that the transaction should be between unrelated person. The transaction should be between unrelated person. Now you may wonder why it is again repeated. We'll see that. This condition is again repeated. Now let us try to understand the detailed part of your 5th, 6th, 7th thing. First 4 condition, nothing more. That's it. There should be sale, nothing more. Delivery should be at India, place of importation, CI value, nothing more. Unrelated person, nothing more. Sole consideration, nothing more. Now 5th condition, what is the 5th condition? In all these 5, 6, 7, 8 cases, there is a possibility that though you don't satisfy this condition, but still you are inside. Let us try to understand that. Unrestricted sales. If there is any restriction, what will happen? The moment there is a restriction, you are going to go to rule 4, rule 5, rule 7, rule 8, rule 9. You are thrown outside rule 3. You have to go as per rule 4, 5, 7, 8, 9. No 6. Rule 4, 5, 7, 8, 9. But then they give an exception. Wait. We'll give an exception. Now what is that exception? If there is a restriction which is by way of law or public authority, which means it is mandatory restriction. It is imposed by way of law or public authority. The exporter of outside India is not putting his own restriction. It is because of the law or public authority that restriction is there. By the way, understand that in all this and entire discussion, I will be the importer in India and as an exporter in USA. So that exporter of USA has put a restriction, but it is required as per law or public authority. Nothing to be done. I will still remain in rule 3. Or that exporter of outside India has put a restriction on me, geographical restriction. He is telling me, the importer of India, telling that your territory is only Tamil Nadu. You don't sell outside Tamil Nadu. That's a geographical restriction. There is a restriction but based on area. Nothing. No need to worry, be under rule 3. Or there is any other restriction which is not affecting the value. The exporter of USA is telling me that you don't reveal these goods till 1st of January. You import and keep the goods. Keep it a secret. This is very common with automobiles. Very, very common with your mobile phones. Especially when you talk about, say, a particular brand, MI mobile phones. Right? They will try Apple. I should tell this example. iPhone. I don't know what is there in iPhone other than I. Right? Nothing special is there. As the users of iPhone, they will not be able to explain. They will fumble while explaining what are the benefits of iPhone. Don't worry. I was one of the users. I have given up. You don't know what are the benefits. And surprisingly, you will find people standing in line for days together, hours together, 36 hours. Recently, person was standing just to get the new version of iPhone 15. I don't know what. And he fought with the salesman. Excellent. That is only a tactics to create a demand. That item would have been imported long back, but they'll tell the importer don't sell it before a particular date. That is a restriction, but is it affecting the value? No. In all these three exceptions, even though there is a restriction, you will remain in rule 3. You will remain in rule 3. That is condition number 5 for you. Condition number 6. There should be unconditional sale. There should be unconditional sale. If at all there is a condition for which there is no value, no worry, be here. If at all there is a condition for which there is a value which you can find out, don't worry. Don't worry. Be in rule 3. Then what is the problem? If at all there is a condition for which you are not able to find out the value, only in that case, go to rule 4, 5, 7, 8, 9 in that sequence. Having a condition is not a problem. If the condition value is 0, nothing to worry, be in rule 3. If the condition value is some value, but you are able to quantify it, be in rule 3. If there is a condition which you are not able to quantify, then go to rule 4, 5, 7, 8, 9. Now next, if subsequent sale proceeds are quantifiable at the time of import, if at all there is any subsequent sale proceeds which is quantifiable at the time of import, which you can quantify at the time of import, there will be an addition in terms of rule 10. The main rule of your valuation is rule 10, where you are going to add a lot of items, 5 plus 2 items. If you are able to know the value, supposing you are going to give a subsequent sale proceeds, which you know the value. Now I am going to pay 1 lakh. Later on I am going to pay 20,000. You know the value. Don't worry. Be in rule 3. But if there is a subsequent sale proceeds which are not quantifiable, assume that they are not quantifiable. If they are not quantifiable, you know that today I have to pay 1 lakh and I have to pay something later to the exporter of USA, something, but I am not able to find out that value now, because he might have said that pay me 10% of your proceeds after you sell. Now pay me 1 lakh, later on pay me 10% of the sale proceeds. I have not yet sold the goods. I am not in a position to find out today. I know at the time of import that the worth of the goods is not 1 lakh. Why? Now I am paying 1 lakh. Later on I have to pay something to the exporter of USA, which I am not in a position to quantify today. What to do? You are not in a position to quantify. Don't worry. Go to rule 4, 5, 6, 7, 8, 9. See, in all these conditions, you are finding one thing very common. You may remain in rule 3 at times, or you will be thrown outside rule 3 at times. Correct? If there is a restriction by law, public authority, geographical restriction not having any value effect, be in rule 3. Otherwise, go to 4 to 9. If there is a condition, value of which is 0 or value of which is quantifiable, be in rule 3. If not quantifiable, go to 4 to 9. If there is a subsequent sale proceeds which you can quantify now at the time of import, be in rule 3. Otherwise, go to 4 to 9. Related person. By default, you are talking about the moment it is a related party transaction. The moment it is a related party transaction, you are going to rule 4, 5, 7, 8, 9. But, if you prove that relationship has not influenced the price, remain in rule 3. If you prove that relationship has not influenced the price, your declared value is closely equal to identical goods value or similar goods value or detective value or computed value. All the different valuation rules. It is closely equal to the valuation rules which will come later on. Then don't go to later on rules. Be in rule 3. So here also, that is the reason it is repeated again. By default, if there is a relationship, you'll go to 4, 5, 7, 8, 9. But if you prove that relationship has not influenced the price, remain in rule 3. Remain in rule 3. So these are the first 4 and the next 4 conditions. First 4 conditions are in terms of section 14, and next 4 conditions in terms of rule 3.2, and the last 2 conditions which are rule 11 and rule 12. Rule 11 and rule 12. What is rule 11 talking about? Rule 11 tells that as a C, you make a promise. You give a valuation declaration on your letter telling that the value that you have declared is full and accurate, true and accurate. And if at all you are asked for any other statement, information and document, please produce it. So assessee is giving a valuation declaration telling that whatever value I am declaring is true and accurate, And if at all you are being called for giving any statement, information or document later on, that will be given by the importer. That is rule 11. Valuation declaration by the importer. Then what is rule 12? Rule 12 is a rule which will give the powers to the proper officer to reject the value under rule 3 and to start 4, 5, 7, 8, 9. Now proper officer, if he is satisfied with the truth and accuracy of the value, valuation will be as per rule 3. But if proper officer is not satisfied with the truth and accuracy of the value, then he'll call for information, documents or evidence from the importer. After seeing the evidence, if he is satisfied, still it will remain in rule 3. If proper officer is not satisfied with truth and accuracy and he is calling for documents, information and evidence, even after seeing the documents, information, evidence, if he is not satisfied or there is no response, then you will start 4, 5, 7, 8, 9. Then you will start 4, 5, 7, 8, 9. And before rejecting the value, there will be an opportunity of being heard given to the assessee. And if at all, importer is telling me that give me the reasons in writing, officer has to give the reasons in writing. Importer can demand the reasons to be written in writing why my value is rejected under rule 3, and officer shall write the reasons in writing why he has rejected the value from rule 3 and why he has gone for 4, 5, 7, 8, 9. That's your rule 11 and rule 12. And they talk about certain special points in rule 12. Why will officer have a doubt? Why at the first instance officer is having a doubt? Either officer sees the goods, your goods are called as subject goods. Officer sees other goods, identical goods, similar goods, and sees your goods you have imported at 1 crore. But identical goods, similar goods have been imported for 1.5 crores. You are showing your import value as 1 crore. At the same time, some other person has imported the same identical goods or somewhat similar goods for 1.5 crores, same quantity, same everything. There will be a doubt in the minds of proper officer. Or you are getting a very abnormal discount from your exporter of USA. Or you are getting a very special discount, which means abnormal discount or special discount, which means again your value is lesser. Your value is, the problem with import is always undervaluation. The problem with import is always undervaluation. Or you have declared something which is wrong, misdeclaration. You have declared something which is wrong. Or you have not declared something which was required to be filled up. Importantly, your quality, brand name and all will be required to be filled up. You are not filled up. Misdeclaration or non-declaration, or the document itself that you have submitted were all manipulated documents, fraudulent documents. These are only examples which will raise doubts in the minds of proper officer. Therefore, he will use the powers under rule 12, ask for additional documents, information and evidence. Even after calling for that, if he is not satisfied, he will reject the value under rule 3 and start with 4, 5, 7, 8, 9. 4, 5, 7, 8, 9. Now, please understand that rule 12 is not a valuation rule. It is only a rejection rule. Why I am telling this? Proper officer would have rejected your value using the powers in rule 12, because he saw that you have shown the value as 1 crore, but the identical goods were imported by someone else for 1.5 crores. Now this becomes very important to tell that he can reject this value under rule 12, but just by rejection 1.4 crores will not become the answer. Why he has rejected it? He saw your value 1 crore, he saw identical goods value 1.5 crores, he compared it. He has got the powers to reject based on that comparison. But after rejection, 1.5 crores will not become the answer. He has to apply the rules in sequence. Then he has to go and apply 4 in detail, then 5 in detail, then 7, then 8, then 9 in that sequence. The basis on which the value was rejected by default will not become the answer, because rule 12 is not a valuation rule, it is a rejection rule. It is a rejection rule. And if the value is rejected here, you have to go as per sequence to next rule, 4, then 5, then 7, then 8, then 9. So that is an important point for you to understand when you are talking about rule 12. Also understand the fact that if I am able to convince the proper officer that my value is true and accurate, though there is a very special discount, officer shall accept it. I may have got a very, very special discount, but with documents, I prove that this value is a true and accurate value. Proper officer shall accept. Normally, other people are getting for 10 crores. I may have got for 7 crores. I prove why I have got for 7 crores. I give all the documents. Officer shall accept my declared value. He cannot tell that no, I have doubts. You had doubts. I explained. I gave all the details. I said why for others it is 10 crores and why for me it is 7 crores. I explained everything. After explanation, if proper officer is satisfied with truth and accuracy, he shall accept the declared value. Now, once you understand rule 3, the main rule is rule 3. The main rule is rule 3. All your questions will revolve around rule 3 read along with rule 10. All your questions will revolve around rule 3 read along with rule 10. Very rarely they will be touching 4, 5 is never touched. Might be they will be touching your 7, 8. Might be. The questions revolve only on rule 3, mainly not even rule 3. The conditions that we have discussed will not be so relevant. What is relevant is the additions. If you recall, in GST, if at all you are satisfying the conditions, your assessable value is equal to transaction value, which is equal to selling price plus service charges minus 2 things plus 5 things. In customs, it is rule 3. Assessable value is equal to transaction value. It is transaction value plus 5 plus 2. There is no minus. Plus 5 plus 2. Plus 5 plus 2. Plus 5 additions of rule 10.1 and plus 2 additions of rule 10.2. 5 additions of rule 10.1 and 2 additions of rule 10.2. Now what are the 5 additions? These will be the questions that in your question paper. We'll be taking the points from these points. 5 additions of rule 10.1 and 2 additions of rule 10.2. Now what are the 5 additions? First addition, let us focus on rule 10.1a. It talks about commission and brokerage except buying commission. Your commission will be added but not buying commission. What is meant by buying commission? Buying commission means the commission paid by Indian importer. Indian, it may be paid to an agent outside India or in India. Don't decide on the basis of agent. Decide on the basis of who's paying. Buying commission means the commission which is paid by importer, whether to an agent in India or outside India. So the moment you get a commission in question, see carefully whether it is buying commission or selling commission. If it is selling commission, add it. Add it. If it is buying commission, don't add it. If nothing is given, by default treat it as selling commission. Add it. By default treat it as selling commission. Add it. So buying commission which is paid by the importer, whether to a broker in India or outside India, will not be added. Will not be added. Now, next addition is your cost of containers and cost of packing, whether material or labor, which means cost of containers and cost of packing, whether it is material or whether it is packing material or packing charges. Packing material cost or packing charges. So your cost of packing charges, your cost of packing material, your cost of container. Container is nothing but special packing. They all will be added. They all will be added. So if you get a question where there's a container cost, packing charges, add it. There's only one exception, one relaxation. What is that? If at all this container belongs to a shipping line which you are clearing, supposing you're importing glass, you're clearing the glass along with that container. So you're clearing the glass along with that container and you promise that you'll re-export within 6 months. You promise that you'll re-export within 6 months. Understand this fact. This container is not permanently coming inside India. It came, you'll unload the glass, you'll again give back the container. If at all you include this cost of containers and pay import duty, again when you send the containers, to that extent you will get duty drawback, not on the full import duty, but to the extent of container you will get duty drawback. Why to pay import duty? There's no question of import duty drawback. So what they tell, if the container is brought and promised to be re-exported within 6 months of import, then it will not be added, but someone has to give a bond. Because we are not adding it. By default, it should be added. We are not adding it. Who has to give the bond? Shipping line has to give a bond, not the importer. Why? The importer will not have regular contact with the customs. Who will have regular contact with the customs? Shipping line. And by the way, these containers generally belongs to whom? Shipping line. So who has to give a bond? Importer is not required to give. Who is escaping import duty on container? Importer. But who has to give a bond? Shipping line. Who has to give a bond? And bond is always its security. Obviously, shipping line will tell the importer to give security. Though it will give a bond, but security generally shipping line will ask importer to give the security. It will not take risk on behalf of the importer. Right. So this is all about the first addition. Now there's a special point given here. Commission paid to canalizing agent. This in fact is not a commission. This we'll be discussing in the later part of the chapter. Rather, we have already discussed. I'll make it your life simple. I am importer 1. I have imported the goods. When the goods are at customs station, customs warehouse, I give you the title. I imported for 1 crore. I am giving the title for 1.2 crores. Who is going to pay the import duty? Importer 1 or importer 2? I imported the goods. The goods are in customs station or customs warehouse. They are not clear. I give you the title. So importer 1 is giving the title to importer 2. In terms of your customs act, who's the importer? Importer 1 or importer 2? Importer 2. Who will pay the import duty? Importer 2. Who will clear the goods for home consumption? Importer 2. On what value? 1 crore or 1.2 crores? 1.2 crores. That 20 lakhs is not commission. It is my profit. I had the title, then gave the title. I took the title, then gave the title. So this commission paid to canalizing agent which is given here, you can write that it is nothing but profit of importer 1. It is technically not commission. I am actually acting as canalizing agent. I imported, I gave you. I did not touch the goods. So in common language, you can call me as canalizing agent. But in reality, I am not the agent. Why? I purchased and I sold. I purchased, then I sold. I got the title, I gave the title. I acted like agent. Why? I never took the goods. I acted like agent, but I was technically not the agent. Who will pay the import duty? You rightly said something. Importer 2. Who is the importer as per Customs Act? Importer 2. Who will file bill of entry? Importer 2. Who will clear the goods? Importer 2. On what value? His value. What is this value? 1.2 crores. Will he tell that no, I'll pay only on 1 crore? No. He has to pay on 1.2 crores. He cannot remove 20 lakhs telling it is commission. He cannot remove 20 lakhs telling it is commission. Clear? It is only a clarification. It's only a clarification. If this was not said, answer would have been the same. You would have finally said that importer 2 will pay on his value. What is his purchase value? 1.2 crores. That's the answer. What is the clarification? Don't remove 20 lakhs. Don't call 20 lakhs as commission. It is not commission. It is profit of importer 1. What is the second addition? What is the second addition? The second addition is a case where I am the importer in India. I have supplied some goods or services to exporter of outside India. I am the buyer. I have given these goods or services free of charge or reduced price to the exporter of USA. I am the importer of India. I am going to import from USA, but I have sent some items from India to outside India. From India to outside India to the exporter of USA at a reduced value or a free of charge. Now understand that supposing that exporter of USA is going to manufacture and give me the shirt. Give me the shirt and assume that the shirt costs is 500 rupees. He is going to sell me for 500 rupees. I tell him, no, you reduce it. I'll send the fabric. So what was his price? The exporter of USA initially said that I'm going to give you the shirt for what price? Give you the shirt for what price? 500. I said that don't worry, I'll send you the fabric. I'm going to send you the fabric. So he started selling fabric. Then what is the price now? Say 250. Indian importer tells that don't worry, I'm also going to give you buttons and threads. Again the price reduces to say 230. Indian importer tells that don't worry, I'm also going to give you design. Directly by him or through some other country. Directly from India or through some other country, I'm going to give you the design. Supposing the price reduces to say 200. Now he tells that don't worry, I'm also going to give you sewing machine, capital goods. Now the amount reduces to say one proportionate cost. We'll take it as say 130 rupees. Now, what is actually imported? Shirt. Do you think that the shirt cost is 130? No. The cost of the shirt is not 130. 130 is a job working charges. Correct? So when you are importing the shirt, you have to pay import duty on 130 or 130 plus something. You are going to pay import duty on 130 plus all these values back to 500. That items that importer is supplying directly or indirectly free of cost or at reduced price to the exporter of USA can be the main material components parts. It can be the main materials components parts, which is raw materials, or it can be materials consumed, which are consumables. In our example, fabric is the main raw material. Buttons and threads can be called as consumables, or it can be tools, dies, molds and other similar items, nothing but capital goods, or it can be services, any design plan sketches or any artwork, development work, engineering work, services. The moment you keep sending these items to exporter of USA, he keeps reducing the price, but when you get the product, you are not talking about the job working charges. Please understand that customs is only on goods. You are trying to collect import duty on shirt, not on the job working charges of shirt. So how to tackle it? From 130 keep adding. Keep adding all these amounts. But one important point. When you talk about your materials or materials consumed or capital goods, material consumed or capital goods, whether they are given from India or whether they are given from outside India, they will be added. But when you talk about designs, if they are given from India, it will not be added. If they are given from outside India, it will be added. If design services are given from India to promote service sector in India, they don't do addition. If raw materials consumed and capital goods are sent from India or outside India, addition will be done. But when you're talking about services, if it is sent from India, not added. If it is sent from outside India, That will be added. That will be added. And one more thing that you need to understand, when you talk about capital goods addition, it will be on proportionate basis. It will be on proportionate basis. Assume that importer has agreed to import 10,000 units. Importer of India has agreed to import 10,000 units. And as of now is importing 1,000 units. And total manufacturing till now has happened of 4,000 units. There are three quantities. The contract number of units is 10,000. Now what you are importing is only 1,000. The export of USA has already manufactured 4,000. Assume that importer of India has sent capital goods to exporter of USA. He has sent capital goods to exporter of USA. What will be the addition that you will do? Exporter of USA is charging only rupees 50 per unit, rupees 50 per unit for each of the units that has been dispatched. What is the contract unit? 10,000. What are the units that is already manufactured? 4,000. This is the contract units. This is already manufactured. What is actually imported now? 1,000. Find out the value. Find out the import price. First, forget about addition. What will be the basic transaction value, declared value? Then you will talk about addition. What will be the basic declared value? How many units are importing? So import duty as of now will be only on 1,000. So import duty will be only on 1,000 multiplied by 50 per unit. What is the answer? 50,000 rupees. Declared value as of now is only 50,000 rupees. There are three answers that you can, option 1, option 2, option 3. Now what is the addition that you will do? Assume that this importer of India has sent capital goods free of cost, the value of which is 10 lakhs. The value of which is 10 lakhs. You are going to add the proportionate cost of capital goods. Now you have three options. This 50,000 cannot be the final answer. Why? Because when importer of India sent capital goods for 10 lakhs free of cost to exporter of USA, he would have already reduced the price. The amount 50 rupees he is collecting, which is after reduction. Now add back. What amount to add? The value of capital goods. What is the value of capital goods that you will add? First answer, add entire 10 lakhs. Now itself add entire 10 lakhs. When balance 9,000 units are imported, don't add anything. When balance 9,000 units are imported, don't add anything. Second option, add 10 lakhs multiplied by how many units are imported now? How many total units will be imported? 10,000. So add now how much? Add now only 1 lakh. Add now only 1 lakh. When balance 9,000 units are imported, keep doing proportionate addition. Third option, add now 10 lakhs multiplied by 1,000 units that are imported divided by 4,000 units that you have manufactured, which means add now only 2,50,000. Add now 2,50,000. When balance 3,000 units are imported, do proportionate addition, and when final 6,000 units are imported, don't do proportionate addition. Don't do, because already it is amortized. These are the three variants we have. Either add the entire cost of capital goods at the time of first consignment, or add the apportioned cost of capital goods based on number of units imported divided by total contract units. Then later on, when the balance 9,000 units are imported, keep adding. In the first case, if you've added now itself, later on you are not going to add anything. Last option. Take this 10 lakhs, take 1000, divided by the manufactured units, not divided by total contract units, divided by manufactured units. Add now 2,50,000. When the balance 3,000 units are imported, which are already ready, do proportion addition. But thereafter, when the last 6,000 units are imported, don't do addition. The most logical calculation is the last calculation, practical calculation. First option is done only when you are expecting the rate to increase. When there is an expectation that import duty rate on this item will be increasing. Otherwise, first option will never go. Among second and third option, what is most logical calculation? It is second. It is not second, it is third. You might feel it is second, but in reality it is third. Why? You are very clear that these 4,000 units will be clearly imported. You are not sure whether balance, see the contract unit is 10,000. It might not happen that exact 10,000 units are manufactured. Correct? So there will be difficulty in calculation or some complex calculation in the end. What to do? Now you do pro rata calculation on the basis of 4,000. You are very sure that balance 3,000 units will be imported, and thereafter don't do any addition. Thereafter don't do any addition. This is for capital goods once ICI has touched it. Rare, but once ICI has touched the same, telling that how you are going to do proportionate addition for your capital goods. Next, you are talking about royalty and license fees, which are related to imported goods and as a condition of sale. As a condition of sale. For example, I am importing a machinery worth 10 crore rupees. And supposing this is very common with hospitals. I am importing a machinery worth say 10 crore rupees. To operate that machinery, I have to pay royalty or license fees to the person who has invented that machinery. So along with 10 crores, I am required to pay another 1 crore. So what will be my value for customs duty purposes? 10 crore plus 1 crore. Why? It is related to imported goods, condition number 1. It is part of condition of sale. When the supplier of USA, exporter of USA would have given this machinery, he would have clearly said, that you have to pay 10 crore plus 1 crore royalty, 10 crore plus 1 crore royalty, or 10 crore plus 1 crore license fees. It is related to imported goods plus it is condition of sale. Plus it is condition of sale. Clear? But what if I don't pay license fees? I tell that this is very common with say books. I normally, if I import say good novels, I have to pay say import price is say 100 rupees, then I have to pay 10 rupees royalty to the author. The publisher will tell that 100 rupees is the price plus 10 rupees royalty to the author. I have to pay import duty on 110 multiplied by the number of books. But what agreement I enter with the publisher? I tell, I am not ready for that. You give me a single book. You give me single book. I'll pay you lump sum 1 crore. I'll pay you lump sum 1 crore. I don't want lakhs of books. You give me a single book. I'll pay you lump sum 1 crore. What was the worth of that book? 100 plus 10. But how much I am paying now? 1 crore. That 1 crore is for what? Right of reproduction. I am telling the publisher, I will have the publishing rights in India. On that rights of reproduction, whether there will be any import duty? No. There will be GST. Import of services, there will be IGST. There will be IGST. There won't be any customs duty. Understand, the worth of that book is not 1 crore. The worth of the book still remains 110. Why I am paying an extra amount, which is a major amount? That is because of right of reproduction. That will attract IGST. It is import of services that will attract IGST. It is escaping customs. Don't worry. It will attract IGST. It will attract IGST. And when you talk about payments made by the importer for right to distribute or reselling that imported goods, which is not a condition of sale. Say for example, I import a machinery for 10 crore plus 1 crore, which is a royalty. I have to pay import duty on 11 crore. I have to pay import duty on 11 crore. 10 crore for the machinery and 1 crore the royalty or the license fees on the machinery. Both the conditions are satisfied. What are the conditions related to imported goods as a condition of sale? I have imported the machinery. I don't know how to use. I call that exporter of USA. Tell that please teach me how to use. They tell that you have to pay another royalty. You have to pay another royalty to know how to use it. That another royalty is 50 lakhs. That another royalty is? Now tell me that whether that 50 lakhs will be added now? No. Why? That was not part of condition of sale. Don't worry. This 50 lakhs will attract IGST, import of services. If you recall your GST provisions, royalty and license fees that are included in customs is exempted from GST. That 1 crore is exempted from GST. 50 lakhs royalty. Second royalty. Royalty and license fees which is not included in customs is not exempted in GST, that will attract IGST, import of services. So I have taken two royalties. 10 crore machinery value plus 1 crore main royalty. Condition of sale, import duty will be on 11 crore, no IGST on 1 crore, exempted. Another royalty 50 lakhs to know how to use it. To know it is not a part of condition of sale. Whether it will be added in customs valuation? No. Whether it is exempted from GST? No. I have to pay on 50 lakhs, import of services, IGST. Import of services, IGST. Now, this point we have already discussed, subsequent sale proceeds. If at all there is a subsequent sale proceeds, if I am paying 1 crore now and I am going to pay 20 lakhs later, what will be the value? If I am paying to the exporter of USA 1 crore now, 20 lakhs later, what will be the value? 1 crore, 20 lakhs, because it is quantifiable at the time of import. But if I am paying 1 crore now and I have to pay something to the exporter of USA later, but I don't know that value. Don't worry about this particular point because you are thrown outside rule 3. You will go to 4, 5, 7, 8, 9. You will go to 4, 5, 7, 8, 9. Subsequent sale proceeds will be added. But understand, if the exporting company of USA is holding shares in importing company of India, that is me, I am deciding to give dividend. Whether that dividend will be added? Clearly the dividend will not be added. Why? It has got nothing to do with import transaction. That dividend will not be added. And finally, the last addition in your rule 10.1, that is rule 10.1e, any other payments, residuary payments, which is made as a condition of sale of imported goods. Very important point, which should be made as a condition of sale of imported goods. Whether I pay to the exporter or third person on behalf of exporter. Similar thing is there in your GST. Payment by recipient to supplier or third party on behalf of supplier. But here there is an extra point. It should be as a condition of sale. Please understand that in your residuary addition, few things will not be added. What are the few things which will not be added? If at all, payment is made for post-importation process, rather this you need to correct it. If payment is made for post-importation process as a condition of sale, it will be added. Normally, anything that you pay after importation will not be added. But anything that you pay after importation, but it was agreed at the time of sale, will be added. Please change it. Payment which is made for post importation process, which was as a condition of sale, it will be added. I'll make your life simple. I have imported a second hand machinery. I am paying 1 crore. The machinery is to be deinstalled from USA For that I am paying 10 lakhs. For that I am paying 10 lakhs. Right? That 10 lakhs I am paying not to the seller, I am paying to the engineer on behalf of seller. So how much, on what value I have to pay import duty? 1 crore plus 10 lakhs. Why? That 10 lakhs was a condition of sale. To sell that machinery has to be deinstalled. That machinery has to be deinstalled. Correct? Now that machinery comes to India. That machinery comes to India. I call the same engineer to install that machinery in India. Whether that will be added? Whether that will be added? No. Why? It is not a condition of sale. Let me change the example. That seller tells that I have great brand value. I cannot allow any person to install my machinery. So, you take my machinery for 1 crore plus 10 lakhs for deinstallation. You bring in India. I will send my person to install it. It is my condition. The seller is very much concerned with the brand value. If you allow anyone else to install it, it may not work properly. Tomorrow my brand value will get decreased. Now, deinstallation was part of condition of sale. Machinery value is 1 crore, clear. Deinstallation 10 lakhs is part of condition of sale to be added. Installation 20 lakhs is also part of condition of sale. It's also part of condition of sale to be added. Though it is after importation, but it is part of condition of sale to be added. I have taken the same two examples. I have made one change. In the first case, the exporter is telling, no worry, you pay me 1 crore and you pay me 10 lakhs for the installation. You don't pay me 10 lakhs, you pay the engineer on my behalf. 20 lakhs, you take care of yourself. If you want, I'll send my person. If you don't want, you take care of yourself. In that case, installation charges 20 lakhs will not be added. I change the question a bit. That 20 lakhs installation is a condition of sale. The seller of USA is very much concerned with the brand value. He tells that no. I cannot allow any person to install it. I'll be sending my person, my engineer. He'll be coming there. He'll be installing it. So you have to pay me 1 crore for the machinery, 10 lakhs for the installation condition of sale, add it. 20 lakhs for installation in India as a condition of sale, add it. So please change that. It has to be added. Interest on late payment, unlike your GST, will not be added if it is genuine interest. In GST, interest on late payment is added. In customs, it is not added. It is not added. Any other work which is done in India, normally any work which is done in India after importation is not added, assuming that it is not part of condition of sale. It is not part of condition of sale. If it is part of condition of sale, add it. If it is not part of condition of sale, forget about it. So that is all and all about your 5 additions of rule 10.1. 5 additions of rule 10.1. Now what are the 2 additions of rule 10.2? What are the 2 additions of rule 10.2? To understand the 2 additions of rule 10.2, let us take this directly, summary directly. You see this summary, it tells how you have to work out your question. Your answer should be in the same type. Particulars, amount in foreign currency, exchange rate, amount in Indian rupees. Line by line conversion do. Don't do total conversion. Line by line conversion you do. What is the first thing? You will be adding your FOB price. That is the exporter's price. Exporter of USA's price. Then add 5 additions of 10.1 which you have discussed in totality. Then add 2 additions of 10.2. Sequence should not be changed. It is FOB plus 10.1 then plus 10.2. Why? You'll understand now. Sequence should not be changed. I say at times will present the answer changing the sequence. But final answer will be the same. I say will try to give an answer which is in a very complicated way. Don't change the sequence. Don't change the sequence. First it is FOB at 10.1. You'll get the corrected FOB or you'll get the adjusted FOB. You'll get the corrected FOB or you'll get the adjusted FOB. Then add 10.2. 10.2, what are the 2 additions? 10.2, what are the 2 additions? One is your freight. Technically it is transport, loading, unloading and handling. It's not only freight, it is transport, loading, unloading and handling charges. We are going to call it as freight. And then you have insurance. If you know the freight amount, if the freight amount is given in the question, take the actual freight amount. Take the actual freight amount. If insurance is given in the question, take the actual insurance amount. If it is ascertainable, take the actual value. But wait, for freight there is a catch. Even if freight is known, if it is a case of air transportation, freight that will be added is actual cost or 20% of adjusted FOB, not the original FOB. What is adjusted FOB? FOB plus 10(1). That is the reason you have to follow the sequence. It is actual or 20% of adjusted FOB, whichever is lower. Whichever is lower. For what? Only for the purpose of air. Only for the purpose of air. Otherwise, you'll add actual. So if you know the freight, add it actually. But if it is by way of air, it is actual or 20% of adjusted FOB, whichever is lower. For insurance, if you know the insurance, add the actual value. But what if you are not aware of freight? Let us only take freight first. If you don't know the freight, but you know the adjusted FOB. If you don't know the freight, but you know the adjusted FOB. If you're not aware of the freight, but you know the adjusted FOB, what to do? Take 20% of the adjusted FOB, not FOB. FOB plus 10(1). Now, there may be one more possibility that you don't know the freight amount, you don't know FOB separately, but you know FOB and insurance. You don't know FOB separately. You know FOB plus insurance. So you don't know the split up between them. You don't have an option. What to do? Go with 20% of adjusted FOB plus insurance. Now what about insurance? If you know the insurance, go with the actual value of insurance. If you are not sure of the insurance, but you know the FOB, go with 1.125% of adjusted FOB. What is this adjusted FOB? FOB plus 10(1). No freight and all. FOB plus 10(1). Now, if you don't know insurance and you don't know FOB clearly, you know FOB with freight. Go with 1.125% of adjusted FOB with freight. Are we guys clear with this understanding? If you know the freight, add actual, but one catch for air, it is actual or 20% of adjusted FOB, whichever is lower. If you don't know the freight, you know the FOB, 20% of adjusted FOB, not FOB. If you don't know the freight, you know FOB with insurance, 20% of adjusted FOB, not FOB. Adjusted FOB, which means FOB plus 10(1). 20% of adjusted FOB and insurance. Now, when you talk about insurance, if you know the insurance, add actual. If not, if you know the FOB value, go with 1.125% of adjusted FOB. FOB plus 10(1). If you don't know the insurance, but you know FOB and insurance, FOB and freight together. If you don't know insurance value and you don't know separately FOB value, you know FOB with freight together. Then your insurance is 1.125% of adjusted FOB with freight. That is all about this 10-2 additions. Few important points in your 10-2 additions. Please understand that when you talk about your demurrage charges, light rate charges, bar charges, they will be treated as freight. You will be adding in 10-2. When you talk about your demurrage charges, light rate charges, bar charges, which is only there for vessel. Demurrage charges, light rate charges, bar charges. Demurrage charges is for weighting the vessel. Light rate and bar charges is for bringing the vessel to the shore. Transferring the goods from mummy vessel to daughter vessel and bringing it to the shore. it will be treated as freight. It will be treated as freight added along with 10(1). Added along with 10(1). If you talk about demurrage charges for airline, demurrage charges for airline, that will not be added. Demurrage charges for vessel will be added, for airline not added. For vessel added, for airline not added. Bar charges and light rate charges are only for vessel, so there's no question. Bar charges and light rate charges are only for vessel, so there's no question, it will be added. Now, another point that you need to remember is, please understand that anything which is happening in India, anything which is happening in India will not be added. Anything. The goods have reached the first point in India. After touching the first point, any transportation charges will not be added. The goods have reached Chennai port. From Chennai port, they are going to go to Coimbatore, not to be added. The goods have reached Chennai port. From Chennai port, they are going to go to Delhi ICD, which is another port, not to be added. The goods have reached Chennai port. From Chennai port, they are going to public warehouse, not to be added. The import continues, but not to be added. Anything which is happening in India with respect to your freight and insurance, which means your transport, loading, unloading, handling, not to be added. Not to be added. Anything which is happening in India is not to be added. Are you guys clear with this understanding? Are we guys clear with this understanding? Anything happening outside India, freight added. In India, not added. Outside India, added. In India, not added. Please remember that. So if it is freight in USA, freight in India, and freight between USA and India, freight 1, freight 2, freight 3. What about freight 3? To be added, not to be added? Freight 2, to be added, not to be added? To be added in your 10-2 adjustment. 10-2 adjustment. Freight 1, to be added, not to be added? To be added. Technically, it should be added in FOB, but ICI tells that it is to be added along with, and it confuses a lot. ICI does not have a very standard policy. In that scenario, it confuses a lot. How it confuses? It tells, let us take an example. Let us take the numbers here. The price, assume that the price is 1 lakh. Assume that the price is 1 lakh. Freight outside India is, say, 10,000. Freight between freight in USA is 10,000. Freight between USA and India is 15,000. And freight in India is 5,000. Let us assume that all these numbers are in Indian rupees for simplicity purposes. Obviously, you have to convert into rupees, but let us understand that it is Indian rupees. Now, understand what should be the right answer. Your right answer should be FOB 1 lakh plus your freight, which is part of FOB, 10,000. So your adjusted FOB should be 1 lakh 10,000. 1 lakh 10,000. 1 lakh 10,000. Then your 10-2 freight. Your 10-2 freight should be only freight 2. Should be only freight 2. Assume that this transportation is by way of air. It is by way of air. What should be the answer? What should be the answer? Maximum of 15,000 or 1,10,000 multiplied by 20%, which is 20. Okay, we'll change this 15,000 to 25,000. We'll change this 15,000 to 25,000. So maximum of 25,000 or 1,10,000 multiplied by 20%, which is 22,000. Whichever is lower, not maximum. Whichever is, you have to go with this. Right? This should have been your correct answer. And your final answer would have been 1,32,000. But ICI tells no. ICI tells, forget about insurance for the time being. We'll focus only on freight. We are trying to understand what is the difficulty in understanding your insurance will be added, by the way. 1.125% will be added. I'm not focusing on insurance at all. Yes, insurance will be added. If the question is not giving, even in that case, insurance will be added 1.125% of adjusted FOB. But ICI tells that what is FOB? ICI tells that FOB is only 1 lakh. Therefore, your adjusted FOB is only 1 lakh. Your adjusted FOB is only 1 lakh. What about rule 10(2) freight? Here you are going to add freight 1 as well as freight 2. Freight 1 as well as, what is freight 1 as well as freight 2 actual? 35,000 or 20% of, no, now ICI tells that 20% of 1,10,000. Now ICI tells that it is 20% of, if it is going wrong, it could have said 20% of 1 lakh. Now ICI tells that no. The real FOB is 1,10,000. 20% of 1,10,000. 20% of 1,10,000. So what is that? 22,000. Let me not write the final answer because obviously there will be insurance. There will be even, I'm not going to write the final answer. There will be insurance. And even for insurance, you should know what is adjusted FOB. For inclusion in 10.1, it tells freight 1 and freight 2 will be included in 10.1. But for calculating the percentage, it tells that no, freight 1 was part of FOB. So what is the answer you get? It is not 20,000, it is 22,000. It's not 20,000, it is. And wait, insurance will be 1.125% of what? Not 1 lakh. 1,10,000. 1 lakh. So this is ICI's understanding. Go with ICI's understanding. ICI tells that freight 1 as well as freight 2 is included in 10.1. It is included in 10.1. Both freight 1 and freight 2. Logically, it should be freight 1 should be part of FOB and freight 2 should be 10.1. Sorry, freight 1 should be part of FOB and freight 2 should be 10 to adjustment. Freight 2 should be 10 to adjustments. But ICI tells that no, both freight 1 and freight 2 are 10 to adjustments. But when ICI is calculating percentages, be 20% of adjusted FOB or 1.125% of adjusted FOB, then they tell that no. For inner calculation, FOB is not 1 lakh, FOB is not 1 lakh, FOB is 1,10,000. 1,10,000. So that you need to remember. That completes our main discussion of your valuation. And once you are done with valuation, make sure that if the question is also asking about import duty, valuation should be always in this presentation. Particulars, foreign currency, exchange rate, Indian rupees. And FOB, 10.1 additions, adjusted FOB, then 10.2 additions. And once you get that, you have to calculate different types of import duties. The normal import duties will be BCD, SWS and IGST. But what are the different types of import duties? It can be BCD and protective duty. The first type. Then it will be social welfare surcharge. Then it will be special import duties, including your safeguard measure, anti-subsidizing duty, anti-dumping duty. Finally, it will be IGST and compensation cess. Why I am splitting into 4? For BCD and protected duty, your value will be the value that you have found out. Supposing you have found out the value as 1 crore. For BCD and protected duty, which is practically BCD for all purposes, protected duty will work like BCD. It will be on 1 crore. It will be on 1 crore multiplied by the percentage. 1 crore multiplied by the percentage. For social welfare surcharge, your social welfare surcharge will be on what? Will it be on 1 crore? No. It will be on BCD plus protective duty. BCD plus protective duty, and the percentage is 10%. What about your special import duties? They will have their own separate calculation. That calculation will be a totally separate calculation. You have to find out the answer and add here. What about your IGST and compensations is? What is the value? All. If you go with only all duties, you will forget one group. It starts with value. It starts with value. The important part is it starts with value plus all the duties, be it BCD or protective duty or social welfare surcharge or special import duties, everything multiplied by the percentage. Make sure that whenever you are working out your duty, have all these columns: particulars, value, rate, and duty, to avoid silly mistakes. That is how your calculation of import duty needs to be done. Calculation of your import duty needs to be done. So that is the main part of your import valuation. We are done with the main part of import valuation. Rule 3 read along with your Rule 10. Rule 3 read along with your Rule 10. All the other rules are very basic and simple rules. Normally not asked in exams as well. Very basic, because the question itself will give an answer. Just like in GSC, you have Rule 27, 28, 29. You will never get any questions directly from 27, 28, 29. Why? The moment you see the question, you have the answer. Now, what is Rule 4 and Rule 5 talking about? We have discussed this in your GSC, so this slide will be very simple here. What is Rule 4 and Rule 5 talking about? Rule 4 talks about identical goods and Rule 5 talks about similar goods. What is the difference between identical goods and similar goods? Identical goods are exactly the same in all aspects, including physical characteristics, quality, and reputation. They might have minor differences, but that will not affect the value. Similar goods means they are not same in all aspects, but have like characteristics and component materials, which enables to which makes them perform same functions, and they are commercially interchangeable. They are exactly not the same, but they are not very different also. How? They have the component materials and characteristics such that they are commercially interchangeable. And they perform the same functions. Which means if you go to market and if you compare both these companies, they will tell that okay, both these companies have got the same brand value. They are not exactly twins, but they are similar. If there is too much variation, it is neither identical nor similar. Now, one more condition that you need to understand when you are saying identical goods, similar goods. These goods should have been imported from the same country of exportation. If my goods are imported from USA, when comparison is done, the comparison should be done of other goods from USA to India. If you are trying to value my goods which have been imported from USA to India, the comparison should be also from USA to India. The persons can be different. Exporter of USA can be different and importer of India can be different. Country of exportation and country of importation should be the same. Exporters and importers can be different. And your identical goods, similar goods will not include a particular case where you have already given a concession. If you recall, in 10.1 edition, there was 10.1b. If I am sending designs from India, it will not be added. Assume that my goods are imported from USA. All of your goods are also imported from USA. All of you are my reference points. My answer will be based on your answer. But wait, amongst all of you, there is one person who had initially sent designs from India to outside India. That cannot be my reference point. Why? For that person, the value would not be the real value. Why? Design was not added. Design was not added. I'll repeat it. My import is from USA to India. All your imports are also from USA to India. By the way, I can compare all of you, assuming that all the other conditions are satisfied. Now, when I'm comparing, I'm seeing a particular person who had imported from USA to India, but she had given designs from India. When she had given designs from India, that design portion was not added back in terms of 10(1)(b). That cannot be the reference. There was a concession given to her by not adding. I cannot take her as the reference point. I cannot take her as that is the exclusion in your identical goods as well as similar goods. What are the steps that you have to follow? First, go with rule 4. Try to find your answer based on identical goods. If not, go to rule 5. First, go to rule 4. If not, go to first find out your identical goods, similar goods from National Import Database. National Import Database. Then see whether they were imported at or about the same time. You cannot see old imports. You cannot see old imports. Then see whether their assessment was final assessment and whether their assessment was done under rule 3 itself. When I am referring someone else, it should be realistic. It should be at or about the same time. And when I am referring you, your value should be neat and clear. If your assessment was provisional assessment, I cannot refer you. If your valuation was not done under rule 3, it was done under 4, 5, 7, 8, 9, I cannot refer you. So it should be first locating identical goods, similar goods. They should have been imported from the same country to India. Exportation country, importation country should be the same. Then filter out old imports, remove them. Then filter out those cases which are under provisional assessment and which were under rule 4 to rule 9. Remove them. They cannot be the reference point. Then see which all transactions are having same commercial value, same quantity, commercial effect and quantity effect. If not same, then try to give an adjustment. Try to give an adjustment. Also give an adjustment for the freight and insurance. Correct? Why? The comparative could be import from USA one city to Chennai, and it could be, my case could be USA another city to Mumbai. So I have to even give freight and insurance adjustment. Freight and insurance, I have to give two adjustments. One, commercial adjustment, quantity adjustment. Other, freight and insurance adjustment. If after doing all this, I get multiple answers. If after filtering out all of them, still I get multiple answers. I get 4 answers. I had initially 10 answers. I removed all unwanted things. I still get 4 answers. What is the solution? Go with the lowest. Go with the lowest. The same step is there for rule 4. The same step is there for rule 5. But first try rule 4. If not successful, then try rule 5. If not successful, then try rule 5. First rule 4, then rule 5. If not successful in rule 4 and 5, what is the next step? Rule 7, which is addition method. Rule 7, by the way, which is deduction method, subtraction method. Rule 8, which is an addition method. Rule 7, subtraction method. Rule 8, addition method. Let us try to understand in a very simple way from this example itself. Supposing the goods were imported from USA to India. My valuation was rejected under rule 3. It is rejected under rule 4. It is rejected under rule 5. Now, please understand that other similar goods would have been imported and sold in India. Would have been imported and sold in India, not my goods, other goods. Other goods would have been, other identical goods or similar goods would have been imported and sold in India. Sold in India, take that selling price. Take that selling price and reduce from that selling price whatever happened in India, reach at this point. Reduce from that selling price whatever happened in India and reach at the cost. Now please tell me what all will have happened in India. There would be taxes and duties in India. Remove it. There would be transportation and insurance in India. Remove it. There would be selling expenses and profit margin of those people in India. Direct selling expenses and profit margin of those people in India. Remove it. At times, there will be some value addition in India. This person would have changed the packaging. Value addition should not amount to manufacture. There would have been some value addition in India. Remove it. Remove it. Whatever happened in India, be it taxes and duties in India, be it transportation, insurance and associated costs in India, be it your selling expenses and profit margin in India, or be it value addition in India, but that value addition in India should not amount to manufacture. Should not amount to manufacture. Remove all of them. Remove all of them. Get the answer. Remove all of them. Get the answer. But there is one problem. When I am referring to identical goods, similar goods, there will be multiple identical goods, similar goods, which are sold at or about the same time. When I am importing my goods, at that time, identical goods, similar goods will be multiple. My same item would have been sold in India by multiple people. Please understand that those identical goods, similar goods should also have been imported from the same country into India, then sold. Then sold as such at or about the same time. At or about the same time. What if I get multiple? What if I get multiple answers? Which selling price should I take? If I get 3 reference point, if I get 3 reference point, which reference point should I select? Reference point which is corresponding to greatest aggregate quantity. It is neither the highest nor the lowest. It is reference point corresponding to greatest aggregate quantity. Say for example, those 3 reference points, the price was 100, 110, 120. 100, 10,000 units were sold. 110, 12,000 units were sold. 120, 9,000 units were sold. What is the price that I'll take? What is the price corresponding to the greatest aggregate quantity? What is the price corresponding to greatest aggregate quantity? 110. I'll go with 110. I'll go with 110. Which reference point I'll select? I'll select the reference point which is having maximum quantity sale. Which is having maximum quantity sale. I'll select that reference point which is having maximum quantity sale. From there, I'll do all the deductions. I'll select that reference point. In this example, all these calculations will be based on which reference point? All these calculations will be based on reference point 2. Will be based on reference point 2. Are we guys clear this understanding? So how I am going to select my reference point? If I have multiple reference point, select the one which is having the highest quantity of sale. By the way, this 12,000 will be not used anymore. Just to select that transaction, I have referred 12,000. Thereafter, this 12,000 has got no relevance in the entire calculation. Are we guys clear with this understanding? Are we guys clear with this understanding? This is everything about your Rule 7 subtraction method. This is everything about your Rule 7 subtraction method. By the way, one small point is left out in Rule 7. Can I take my own goods as a base? Can I take my own goods as a base, or I should refer identical goods, similar goods? Normally, I should refer identical goods, similar goods. Why? I am trying to find value of my goods. When I am trying to find value of my goods, they are not yet cleared. When they are not yet cleared, there will be no selling price. So I have to refer to identical goods, similar goods. I have to refer to identical goods, similar goods. But there is one way where I can refer my own goods, where I can refer my how? Go for provisional assessment. Go for on some rough basis, pay some duty. Promise that within 90 days you will sell your goods and you will take your selling price. Starting from your selling price, reduce everything happened, what happened in India. Normally, the basis of rule 7 is other person's goods, identical goods, similar goods. Because when I am importing my goods, they are yet to be cleared. So when they are yet to be cleared, I cannot have selling price. I have to refer to some other goods. But can I refer the own goods and try to calculate entire rule 7? Yes. How? Take the help of provisional assessment. Randomly, roughly pay some duty what officer is demanding now. Promise that you will sell within 90 days. Sell it. Take your selling price. Remove everything that happened in India. Remove everything that happened in India. So that is all about your rule 7. Rule 7. Now, rule 8 is exactly opposite of this, which is addition value. What if I tell you that you are not successful in finding out your rule 7? You can go with rule 8. What is rule 8? You start with the cost of material of the exporter, add cost of production of the exporter, add selling expenses and profit margin of the exporter, add freight and insurance in terms of rule 10(2), you will reach at India, which is CIF. This is nothing but your rule 8. You will start with the exporter. You contact your exporter. Ask his cost of material. Ask his cost of production of fabrication. Ask his selling expenses, profit margin. Add freight and insurance between USA and India. Arrive at your CI value in terms of rule 8. But there is a big problem here. This is workable only in case of related party transaction. Normally, an exporter will never give all this information. Only if he is a related person, he will share all this information. Only if he is a related person, he is going to share all these information. Otherwise, these information will not be shared. These information will not be shared. Right. So that is rule 7, subtraction method, deductive value method. Rule 8, addition method called as computed value. Normally, what is the sequence that we discussed of the rules? Rule 3, rule 4, 5, 7, 8, 9. What is rule 6? Rule 6 is sequence changer. Importer can request and proper officer can accept to change the sequence from 3, 4, 5, 7, 8, 9 to 3, 4, 5, 8, 7, 9. Why this importer will request? Because importer will tell that my transaction is a related party transaction. You have removed from rule 3, rule 4, rule 5. First try rule 8. If not satisfied, then try rule 7. Then try rule 7. That is all about your rule 7 and rule 8. And the last part is your residuary method. Residual method tells that best judgment valuation to the best of the judgment of officer. He will try to give a value. But there is a catch. Officer cannot give a value which is more than the market value of the goods when sold in India. Officer cannot give a value which is more than market value of the goods when they are imported, and it cannot be too high value. It cannot be a very high value. Now, there are certain ifs and buts for the officer. Officer should, even when he is doing best judgment, he should take care of certain things. What are those things? Just think of this, you'll automatically find all these answers. I was importing from USA to India. Can officer take the base as USA China? Can officer take the base reference point as USA China? No. Can officer take the reference point as USA USA? No. Can officer take the reference point as India India? No. So they are trying to tell that when you're trying to find a base, officer cannot take the base as goods produced in India, sold in India, goods produced in the USA and sold in the same country, goods produced in USA but sold to China, but sold to, the reference point should always be USA, India. If my goods are imported from USA, India, the reference point even in rule 9 should be USA, India. Now, what if officer is getting multiple answers? Officer cannot select highest, cannot select lowest, cannot select any arbitrary value or fictitious value. Then what is expected of the officer? If officer is getting multiple answers, select the one which is more appropriate or more logical than the other. He cannot select just because some value is higher, he'll select that. Some value is lower, he'll select that. Some random value, he'll select that. Supposing 100, 112, 115, 120 is the answer. Final answer in terms of rule 9. Officer cannot go with 100, cannot go with 120, cannot go with 112, cannot go with 115, just like that. He has to select any of them, say for example 112, and tell why 112 is more valid than other three. Can you apply your addition method with respect to identical goods or similar goods? When you talk about your addition method, it was applied on your own goods. Can you apply computed value for identical goods, similar goods? Yes. If the formula of rule 8 is applied, no worry. If you don't apply the formula of rule 8, then you cannot do. Now please understand that rule 8 computed value was done on the basis of your own goods. You did not take any reference point. You added everything of your own goods. You did not went to identical goods, similar goods. Under rule 9, can you apply computed value of identical goods, similar goods? Yes. If you apply the same formula that of rule 8. If you apply the same formula that of rule 8. Now just for your understanding purposes, if your value is under rule 3, you'll have only one answer. If your value is under 4 and 5, you may have multiple answers. If you have multiple answers, select the lowest. If you are valuing under rule 7, you may have multiple answers. Which one to select? Select the one which is against the highest aggregate quantity. Highest aggregate, that will be a reference point, and work on the basis of that. In rule 8, you will never get multiple answers because rule 8 is on your own goods. If in rule 9 you are getting multiple answers, most appropriate amongst others you have to select. Most appropriate among others you have to select. For second hand machinery, can you apply depreciated value method? A repeated question. For second hand machinery, can you apply depreciated value method under rule 9? Can you apply depreciated value method under rule 9? Yes, but there is a catch. Even for second hand machinery, start from rule 3, then rule 4, then rule 5, then rule 7, then rule 8, then rule 9. Directly you cannot bring under rule 9. Follow the sequence 3, 4, 5, 7, 8, 9. If you have tried everything else, you have come at 9. Then for second hand machinery importation, you can apply depreciated value method. If you have tried all the rules and then come at rule 9, you can use your depreciated value method. So that is everything about your import valuation rules. What are the valuation rules basically? Main rule is 3, followed by 4, 5, 7, 8, 9. Push and addition is rule 10. So main rule is rule 3. It will be always straight along with 10 addition. Rule 3 plus rule 10, 1, 5 additions, 10 to 2 additions. Rule 4, rule 5 normally no questions will be touched because the moment you know the logic, straight away you know the answer. But 7 and 8, for sure, 7 importantly, there can be beautiful questions asked in 7, and ICA has asked a few times when you're talking about calculation part of 7. Calculation part of 7, that is subtraction method or deductive value method. So that is all and all about your import valuation rules. When you talk about your export valuation, the moment you find your import valuation, automatically export valuation is 90% done. The main difference between your import valuation and export valuation is import valuation is based on CIF, cost insurance freight. Export is based on FOB because it is talking about the goods when they are leaving India. That is FOB. Import when they are touching India, which is CIF. Now, other differences. In your import valuation, you have something called as identical goods, similar goods, and related person. Same related person is there also. But in your export valuation, you don't have identical goods, similar goods. You have a combo. You have goods of like, kind, and quality. Now, you can easily link with your GST. And by the way, when you refer to the definition of goods of like and kind and quality, they use the term identical or similar. In the BAR Act itself, they use the term identical or similar. They are trying to make it more simple. Just really no need of identical, no need of identical, no need of similar. We'll go with a simple term, goods of like, kind, and quality. What is the main rule for your import valuation rule? What is the main rule? It is rule 3, which is declared value, which has got additional conditions like unrestricted sales, unconditional sales, subsequent sale proceeds should be determinable. In export, just think of this. Export, government wants to add to valuation or to have lesser valuation. Lesser valuation. Because more is the value of export, more will be the export benefits. More the value of exports, more will be the exports. Duty is very rare. Export is all about benefits. The problem with import is undervaluation by assessee and officer will try to add it. The problem with export is overvaluation by assessee, which you have seen in duty drawback, and officer will try to reduce it. Will there be any extra conditions here? Nothing. No extra conditions. No extra conditions. Mind you, along with this rule 3, what was the most important rule? You are going to add 10-1, 5 additions, and 10-2, 2 additions. In export, there are no additions. They don't want additions. They are not interested in any additions. There are no additions. There is no concept of addition. There is no concept of, it is straight away FOB value. It is straight away FOB value. Now, if you are not successful at rule 3, what is the next rule that you take in import? What is the next rule that you take in import? Rule 4 followed by rule 5, which is identical goods, similar goods. In your export, it is goods of like, kind, and quality. It's goods of like, kind, and quality. In import, they are very specific. Country of origin and destination both should be the same. Country of origin, that is exportation USA, and destination, which is India, both should be the same. Both should be the same. More importantly, country of origin should be the same. Because in import, destination is India. Your country of origin should be the same. If you have imported from USA, your reference point should also be from USA to India. But in export, they are not bothered about the destination point. If you are referring to someone else, it should have been exported. You have exported from India to, say, Sri Lanka. When you are taking your reference point, that is goods of like, kind, and quality, that goods of like and kind and quality can be India to Sri Lanka, or India to China, or India to USA. You are not bothered. You are not bothered. So your country of destination may be the same, may be different. May be the same. But yes, you should take only export transaction. Reference point is export transaction, but not necessarily India to Sri Lanka. It may be India to Sri Lanka or India to any other country. Now, what is the next step in your import? Once you are done with 3, 4, 5, what is the next step? What is the next step? You are talking about rule 7. What is that? What is that? Deduction value. Just think of this. For export, can you ever have deductive value? You are exporting from India. Now you are telling go outside India to Sri Lanka. From there, take that selling price. Come back. What you will tell? Why you are going there? I am here. I am the exporter. I am here. There cannot be any concept of deductive value. Think logically. It cannot be there. When you are the exporter sitting here, when you can give all your cost of production details, why to go to the other country, take the selling price and return back? Not logical. There's no concept of deductive value. What is the next rule that you'll apply in your import? Rule 8, computed value. Here, yes, you'll have a comparison. If you are not successful with rule 3, declared value, rule 4, goods of like kind and quality, then you will go to rule 5, computed value. See, there it is 3, 4, 5, 7, 8, and export it is 3, 4, 5. Declared value, like kind and quality. If there is no concept of deductive value, there is no question of any changing the sequence. Directly computed value. Declared value, goods of like kind and quality, and computed value. Now, in your import valuation, rule 9 is best judgment valuation. Obviously, you will have best judgment valuation even in your export valuation. So there it is rule 3, 4, 5, 7, 8, 9. Here it is 3, 4, 5 and last best judgment valuation 6. That's it. And in your import valuation, importer has to give a valuation declaration under rule 11 and officer can reject your value under rule 3 based on rule 12. Likewise, there exporter has to give valuation declaration under rule 7 and officer can reject your value under rule 3 based on rule 8 rejection. Very, very simple to understand. The moment you are clear with export, questions are never asked. Rarest of the rare scenarios. But please remember, if at all they ask export questions, there's nothing to worry about. The moment you have gone through all the ifs and buts of import valuation, hardly it will take 5 to 6 minutes to know what is your export valuation. One point don't forget, export is all based on FOB, import is all based on CF. So that is all about your export valuation. Now, when you talk about your valuation question, a part of valuation question is to find out the correct exchange rate. And to calculate the duty, correct rate of duty. Now, please understand the possibilities, and the moment you understand the possibilities, things are very simple. If you're directly clearing the goods from customs station, let us focus only on import. You have filed your bill of entry for home consumption on a particular date, say 1st April, and the goods have arrived. Arrival of vessel, aircraft or vehicle, it is on say 4th April. Another scenario, bill of entry for home consumption is filed on 4th April and arrival of your vessel, aircraft or vehicle is 1st April. First is a situation of advance bill of entry. Second is a situation of normal bill of entry. They'll try to give the numbers in ulta ways. You have to see, in the first case, you have filed bill of entry before the goods have arrived, before the arrival of vessel, aircraft or vehicle. Correct? Before it has arrived. So it is advance bill of entry. In the second case, you have filed bill of entry after the arrival of vessel, aircraft or vehicle, which is a normal bill of entry. In case of, now let us give the questions. Supposing exchange rate here is rupees 75 per dollar, here it is rupees 76 per dollar. We'll take the same thing. So rupees 75 per dollar and rupees 76 per dollar. Rate of duty is 10%, 20%. Rate of duty is 10%, 20%. This exchange rate in customs, you are going to take CBIC exchange rate. Rate of duty will be given in the question. Exchange rate is always of CBIC. If you get in question RBI exchange rate, FEDI exchange rate, ignore it. Focus on CBIC. Now first select the date, then select the rate. Now tell me, what about What about your exchange rate and what about your rate of duty? For your exchange rate, always go with bill of entry. Always go with bill of entry. Always go with bill of entry. So what is the bill of entry? Date, here it is 75 rupees. Here it is again 75 rupees because you are going with bill of entry. Bill of entry. Always go with bill of entry. Here bill of entry was filed on 1st April. Here bill of entry was filed on 4th April. Always go with bill of entry. Always go with bill of entry. For exchange rate, there is no other answer. Go with bill of entry. By the way, exchange rate is part of valuation. It's part of rate of duty is calculating duty, but exchange rate is part of valuation. That is discussed in section 14. Exchange rate is discussed in section 14. Rate of duty is discussed in section 15 for import, section 16 for export. What about rate of duty? What about rate of duty? Which one to select? Whichever is later. Whichever is for your rate of duty. Go with whichever is later. Go with whichever is later. Which is later? 1st April or 4th April? 1st April or 4th April? 20%. Now which is later in the second case? 4th April or 1st April? 4th April. So which rate? Got that? Exchange rate always go with bill of entry. But rate of duty go with bill of entry or arrival of vessel, aircraft, vehicle, whichever is later. Whichever is later. This is discussed when the goods are directly cleared from your customs station. What if you are taking the goods to customs warehouse, then clearing it? You will file two bill of entries. Bill of entry for warehousing and bill of entry for home consumption. Bill of entry for warehousing you have filed on say 1st April. Bill of entry for home consumption you have filed on say 10th December. Now your exchange rate given by CBIC will be different on both these dates. Rate of duty may be different on both these dates. Let us assume that your exchange rate is rupees 80 per dollar and rupees 83 per dollar on these two dates. And rate of duty 10%, 20%. For your exchange rate, you always go with the first bill of entry. You always go with bill of entry, that too first bill of entry. You always go with bill of entry, that too, if there are two bill of entries, go with first bill of entry. So what will be the answer? 80. For your rate of duty, you always go with whichever is later. Correct? In that previous case, whichever is later. Now here, there was only one bill of entry with arrival, whichever is later. Here there are two bill of entries. Which is later? Second one. So you will take 20%. You will take 20%. Clear? That is for your import purposes. And for export, there will be only two dates: shipping bill, bill of export, and late export order given by the officer. Shipping bill of export filed by the exporter, late exporter order given by the proper officer. Assume that shipping bill you have filed on 10th April, late export order will always be given after that. 15th April. Exchange rate given by CBIC, rate of duty. Normally export duty will not be there, but if there, what do you have to do? Now let us assume that your exchange rate is rupees 83 per dollar and rupees 84 per dollar on these two dates. Rate of duty within 5 days changed from 5% to 7.5%. Now, if you recollect your exchange rate concept in import, it always goes with the first thing or the last thing. Exchange rate. E, then R. E is first, then it is R. It always goes with first thing. So, it will always go with the date of shipping bill or bill of export. So, your exchange rate will be 83 per dollar. What about your rate of duty? If you understand your import, Your rate of duty always goes with the earlier thing or the later thing. Earlier thing or the later thing. What is later? Late export order. So what will be the rate of duty? 7.5%. 7.5%. Exchange rate, be it import or export, is discussed in section 14. Rate of duty for import is discussed in section 15. And rate of duty for export is discussed in section 16. Are we guys clear with this understanding? Are we guys clear with this understanding? It is just like your time of supply to select the correct rate and to find out the final payment. It is just like your time of supply. Don't you think in your time of supply there will be a residuary provision? Assume in import and export, you don't file bill of entry, you don't file shipping bill of export. You are a smuggler. You are a smuggler. What will happen? What will be the relevant date? Remember your GST. What will be your? In case of smuggling. In case of smuggling. Date of payment. Date of payment. That will be the relevant date. Something is better than nothing. At least have that relevant date. Something is better than nothing. It is date of payment. So that is everything about your selecting the exchange rate and selecting the rate of duty, which will be part of your valuation question. Right. Thank you. So when you talk about this chapter baggage, small chapter but very important chapter, simple chapter for your marks purposes. Now what do you mean by baggage? Baggage in simple language means your personal effects, but other than motor vehicle. Motor vehicle will never be categorized as baggage. You can never call motor vehicle as a baggage. It will always be treated as commercial cargo. So when you want to understand baggage, understand that goods can be categorized into baggage and commercial cargo. What do you mean by commercial cargo? All other goods other than baggage are commercial cargo. All goods other than baggage are all commercial cargo. Motor vehicle is always commercial cargo. What is the significance of baggage? Baggage, you might end up paying customs duty, but you don't require I-code. You don't require I-code, import-export code. For commercial cargo, for you to import commercial cargo, you do require I-code. For you to import and export commercial cargo, you do require I-code. For baggage, for you to bring and take out baggage, you don't require I-code. When you bring in baggage, at times you end up paying import duty. Though you are making the payment of import duty, you don't require I-code. Now, when you talk about commercial cargo, what are the main forms for clearing the goods? Be it import or be it export. For import, bill of entry. For home consumption, if you're directly clearing it from customs station, or bill of entry. For warehousing, take it from customs station to customs warehouse. From there, file bill of entry for home consumption and take the goods. Bill of entry. For export, shipping bill or bill of export. Shipping bill or bill of export. These are the customs document for importing your goods and exporting your goods. When you talk about your baggage, no documentation, no customs document. This is baggage declaration form. That too, when you talk about baggage declaration form, if you have got nothing to declare, no need to even declare anything, no need to even tell anything. Just walk in the green channel. In the international airports, there will be two channels, green channel and red channel. And whenever you are coming from an international flight or going outside in an international flight, understanding their customs law, you will be given a advisory kind of stuff, that what is to be done and what is not to be done. So if you have nothing to declare, walk in green channel. If you have something to declare, then you have to walk in red channel. When you have something to declare, walking in red channel, there you have to give a baggage declaration form. There you have to give a baggage declaration form. Section 77. Now, as I said, at times you may end up paying baggage duty as well. Customs duty on baggage. Now, before we go to customs duty, What is the classification of baggage? Commercial cargo will always have separate classification. From chapter 1 to chapter 96, there will be separate classification of each of the item. For mobile phone, there will be a separate classification. For laptop, there will be a separate classification. For watches, there will be separate classification. For perfumes, there will be separate classification. For accessories, there will be separate classification. But all these items, right, starting from your mobile phone, laptop, watches, perfume, accessories, if you bring them as baggage, they're all classified under the same heading 9803. If you bring them as commercial cargo, they'll be having separate classification. But if you bring the same items as baggage, forget the technical classification. Focus on chapter 98 heading 9803. Chapter 98 heading 9803. In short, you don't see what exactly the item is. You call it as baggage. Be it your laptop, be it your mobile phone, be it your watch, be it your new clothes, be it anything. You call it as baggage. You call it as baggage. 9803. Now, commercial cargo, when you have commercial cargo, respective import duty you are going to pay. BCD, SWS, IGST based on the classification. There's no exemption. At times you are required to pay additional import duty, special import duties. Anti-subsidizing duty, anti-dumping duty, safeguard measure. These are three special import duties at times you are required to pay. But when you talk about your baggage, you will be paying only and only BCD and SWS. IGST is exempt. IGST is, what is the BCD rate which is there under 9803? 35%. What is the social welfare surcharge which will be charged on BCD? SWS will be charged on BCD 10%. Net effect, what will be the rate? 38.5. 38.5. So that is given in for your exams. Whenever a question of baggage comes, it is 38.5, right? 35% BCD and 10% SWS on that BCD. IGST is exempt. Now moving on to the provisions of baggage, directly we'll see the sections all here. Section 77, we are done. Declaration. If you have nothing to declare, no declaration. If you have something to declare, give a baggage declaration form, walk in the red channel. Section 78 also we have completed. What is the relevant date for finding out the import duty on baggage? Date of giving declaration. As on date, the rate is 38.5. As on date, the rate is 38.5. That is section 78. Section 79 tells that if you are bringing bona fide baggage, if you are not hiding anything and bringing your baggage, you will get baggage exemption, technically called as general free allowances. General free allowances. GFA. General free allowances or duty free allowances. General free allowances. In simple language, section 79 gives birth to baggage rules 2016. Section 79 gives birth to baggage rules 2016. Then you have something called as section 80, very peculiar provision and very logical provision also. Section 80 tells that, just understand we are talking about a foreigner. Keep that in mind and discuss this provision. If the foreigner comes and he is surprised to see the baggage laws of India, he has brought a lot of items and suddenly he sees that he has to pay duty, then he tells that no, out of all these 10 items that I've got, a guitar, etc., all I've got, I don't require these in India. India is a musical country. I'll find music anywhere. So I don't require all these instruments to be taken along with me. So what he does? He is asking the proper officer to take these baggages, whether they are dutiable or prohibited. Take these baggages. He might bring something which is not prohibited in his country, which might be prohibited in India. So he is asking the proper officer, please have this baggage and detain this baggage. But the condition is, the passenger should have given true declaration. True declaration. Proper officer may detain that article. Now, for the very first time, you will find something very peculiar in customs law, where detention is being asked by the assessee. Assessee is coming and telling that, see, I've got these dutiable goods or prohibited goods. And prohibited goods I cannot take inside. Dutiable goods, if I take, I have to pay baggage duty, and if I go back, I'll have to claim the refund. I have heard about India. Refund is very difficult to get. So, better I keep the goods here. You please detain the goods. I'll be paying the prescribed fees. I have to pay some fees. Right? You keep the goods here. These detained articles will be returned back to the passenger when he's going, or can be returned back to another passenger on the instruction of the main passenger, or if that passenger is coming via Chennai but leaving via Mumbai, he can also inform the officer to send it as a cargo consignment. It's possible. Obviously, he has to pay the charges. He's required to pay the charges. That is section 80. That is section 80. Now, whatever you discuss is not for your exams. Now starts your exam calculation. Only from these areas you will be getting questions in your exams. All the duty-free exemption limit, otherwise called as general free allowance, is there in your baggage rules. Baggage rules. Now understand that how to remember rules. First, it is either rule 3 or rule 4. Rule 3 or normally the rules that is applicable is either rule 3 or rule 4. If you are bringing jewelry, new jewelry, rule 5. Rule 5. And if you are permanently transferring your residence, rule 6. Normally you will not be touching 5 and 6. 7, 8, 9 at a time pass. Waste of time. Alright. The rules are only 3, 4, 5, 6. The calculation rules are only 3, 4, 5, 6. Main rules are 3 or 4. It is either 3 or 4. 5 when jewelry is involved. 6 when you are shifting your residence from outside India to India. Now rule 3 or 4. Why I am telling 3 or 4? 3 or 4. 3 is applicable when you are coming from a country other than Nepal, Bhutan, Myanmar. Whenever I see this, I am helpless. I keep telling this. Indian government made a mistake in 2016 by removing China from here. It was Nepal, Bhutan, Myanmar and China. Nepal, Bhutan, Myanmar, and that was the only period where we were a kind of having good relationship with China. We did not make this single mistake in customs. So you made another mistake. There was a special safeguard duty only for Chinese products. We understood that China is going to change. We changed the provisions. I don't really understand now when the situation is back to zero, why don't they bring those provisions back? It's not there. So here it is Nepal, Bhutan, Myanmar. Why I am telling is, if you are coming from USA to India, rule 3. China to India, rule 3. Coming from USA to India, rule 3. China to India, rule 3. More exemption. More exemption. And people misuse this China provision like hell. Whenever they used to go to China, there was a list. Even when your friend goes outside India, there's a list. Every time he'll bring one item for you. Right? China was misused to the people in airports. When they were coming from China, they used to carry LCD, LED. And then they realized, no, not done. They put that in Annexure 1. Thanks to China. They put that in Annexure 1. Annexure 1, you cannot take any baggage exemption throughout rule 3, rule 4, rule 5, rule 6. Your flat panel television, be it LCD or LED. If you go back and see the amendment history, you'll understand it. You'll appreciate it. Why it was brought. It was not there in the beginning. The items were stopping. This point was not entered there. Thereafter, when they amended this provision, they amended a lot of things. But the amendment which was for China, relaxation for China, was earlier than this amendment of flat panel television. Because they were seeing that people were going to China and coming with, everyone is wanting a television. And at times officer was seeing these people and seeing that again this person is coming. Few people will be regular visitors to China for business purposes. Every time he's coming, every time he's bringing television. God only knows how many television he's having at his home. Right, so therefore they said that we are not going to give any baggage exemption for flat panel television, be it LCD or LED. So that was introduced again because of China. Now coming back to your rule 3, if you're coming from USA to India, rule 3, China to India, Sri Lanka to India, rule 3. But if you're coming from Nepal, Bhutan, Myanmar to India, it is rule 4, lesser exemption. Lesser exemption. Lesser exemption. If your trip starts at USA, then to Nepal, then to India. Starts at USA, then to Nepal, then to India, rule 4. Rule 4. If your trip starts at Nepal, then to USA, then to India, rule 3. And when I'm telling trip, you are actually staying there. I'm not talking about connecting flights. If it is USA via Nepal and India, it will be treated as US only. Nepal was only a intermediary airport. I'm not talking about that stuff because you never entered the real landmass of Nepal. So that point I'm not talking about. You stayed there. I'm talking about a case where you stayed there. Now, what is the difference between rule 3 and rule 4? Now, what is the common point first we'll cover? First, they talk about infants. First, they talk about infants where you're talking about a child up to 2 years old. Up to 2 years old. For infant, they tell that we will give the benefit for the used personal effects, unlimited exemption. Their used items, full exemption. Their used items, full exemption. Their used items we will be giving full exemption. When I tell no upper limit, it means full exemption. But it is used personal effects. When I talk about used personal effect, it means used items. Used items, old items, used old items, full exemption. Full exemption. Now let us see the differentiating fact. Rule 3 is bifurcated based on the type of passenger. The type of passenger. If you are an Indian resident or foreigner residing in India, which means he is permanently there in India, foreigner residing in India, he is not a tourist. He is not a tourist. What do you mean by tourist, by the way? Tourist means a person who stays in India for less than 6 months. For less than 6 months. He is not a tourist. Say for example, a foreigner has come to India and he is taking a spiritual course for a long time in Isha Yoga. He is a foreigner residing in India. He is not a tourist as per your GST law as well as your customs law. Both the definition in GST law and customs law is the same. Or tourist of Indian origin, which means now you are talking about the tourist, but origin is India. Origin is India. So you are talking about tourist of Indian origin. Right. In the first category, they will give you more exemption. What is the second category before we see the exemption? Second category is tourist of foreign origin. Might be he is going to come soon. Tourist of foreign origin. Tourist of foreign origin. Right. So first category is Indian resident. Indian resident means a valid passport holder. Indian resident means a valid passport holder. Second, foreigner residing in India, tourist of Indian origins. Next category, tourist of foreign origin. Tourist of foreign origin. Now, in the first category, if you are talking about your used personal effects and traveling items, used personal effects and traveling items, unlimited exemption. Even in the second category, if you are talking about used personal effects and traveling items, unlimited exemption. There's no limit. There's no limit. For your old items, there's no limit. The limit is only where? The limit is only where? For the new items. For the new items. For your new items, where you're talking about articles other than, don't remember Annexure 1. Annexure 1 benefit is not there in any of the rules. Just remember for your new items. For your new items, limit is 50,000 for the first category. Limit is 15,000 for the second category. 50 for the first category, 15 for the second category. What is common in both these categories? Used items, unlimited exemption. What is differentiating factor? New items. New items. First category, 50,000. Second category, 15,000. Just remember these numbers. We will continue these numbers in rule 4. In rule 4, the bifurcation is not based on the type of passenger, it's based on the travel route. It's based on the travel route. If you are traveling by air or water, if you are coming from Nepal, Bhutan or Myanmar through air or water other than land, or if you are coming through land, if you are coming through land. Even here, if you are coming by whether air or water or whether by land, used items. Technically, there is traveling items which is removed in the next category, not so important. Used items, unlimited exemption. With respect to used items, there is unlimited exemption. Even here, there is no difference. Be it rule 3, be it rule 4, be it any type of passenger, be it any type of route. Used item, unlimited exemption. The difference is only where? New items. Difference is only where? New items. New items is the first category. The lower limit of rule 3, the lower exemption of rule 3 is the higher exemption of rule 4. Now it is 15,000. First category in rule 4 is 15,000. Second category, no exemption. When nothing is given, it is no exemption. No exemption. You can remember this way. 50, 15, 15, 0. We are only talking about your new articles. You need not remember other than Annex 1 because Annex 1 benefit is not there under any rules. Be it rule 3 or rule 4 or rule 5 or rule 6, you don't get baggage exemption for Annex 1 items. Now, if it is rule 3, 50, 15, rule 4, 15, 0, only for new articles. Here the categorization is Indian resident, foreigner residing in India, tourist of Indian origin, tourist of foreign origin, tourist of Indian origin and tourist of foreign origin. Here it is by way of air or water, by way of land. By way of land. That's it. Remember this. That's more than sufficient. More than sufficient. Used items, old items, anywhere, unlimited exemption. Unlimited exemption. Infant, they will not get new items exemption. You cannot tell that there is a husband and wife and a 1-year kid and tell that this 1-year kid requires a phone. Don't do this stuff. But if it is 3 years kid, then you can plan. Then you can plan. If you have brought 3 items, you can tell that this is mine and this is my wife's and this is for my child. You can plan. That planning you can do. Not for an infant less than equal to 2 years. The moment he has crossed 2 years, you can start your planning. You can start your planning. Next, you are talking about your rule 5. Rule 5 is exemption for jewelry. One very important point that this exemption for jewelry is only applicable for a passenger who has stayed more than 1 year. More than 1 year before his return to India. He went outside India, stayed for more than a year, then he came back. You cannot tell that, no, I went to Dubai. I saw gold at a very lesser price. I thought that I'll take this benefit. I have read Rule 5, but I have not read Rule 5 fully. Because this benefit is only for passengers who stayed there for more than. So without even starting the numbers, I am telling the condition. This is applicable only for a passenger who has stayed there for more than a year and then coming back to India. Obviously, Rule 5 and Rule 6 are extra exemption. I need not tell. Rule 5 is in addition to Rule 3, Rule 4. Rule 6 is in addition to Rule 3, Rule 4. So that is a clarification. That is a clarification. Now, what is the exemption that you'll have? What is the exemption that you'll have? Again, they realize the fact that men and women are different. I don't know why people nowadays are confused. Woke culture, wake up, right? High time Understand that women were always stronger than you. Physically, might be not, but mentally, always. They have something with them and you have something with you. Right? Give utmost respect to women because your origin itself is a woman. But at the same point of time, don't do it into an extent that today you will tell that I am a woman. Tomorrow you will wake up and tell that I am a male. No, no. That culture, let it be there in US. Let this not come in India. Right? That woke culture, if at all you are one among the woke culture, wake up. Now when you talk about the difference, they do realize the fact that there is something which will be different for a gentleman and for a lady passenger. So they understand this fact and they differentiate it. What is the exemption? Who will get more exemption? In India, needless to say. Who will get? Even here, they recognize the fact that women are more stronger than men. They want something more than men. Who will get more exemption? Lady passenger. Who will get more exemption? And that too, it is all about jewelry. That too, we are in the state of Tamil Nadu. We have some history of Tamil Nadu, right? Let us not enter into that. But when you talk about jewelry, it has got deep roots across India. What is the exemption that you get? For a gentleman, 20 grams or don't tell me the market price and all. I am aware. Right. But still, technically it is 20 grams or 50,000, whichever is lower. And 40 grams or 1 lakh, whichever is lower. Please understand that you have to convert it into rupees, then compare. Convert it into rupees, then compare. For example, if you're talking about a lady passenger and if it is given that 50 grams is brought and for a value of say 60 grams, I know that the value is not real that I'm putting. Right, say 50 grams is there for 1 lakh. Pray it will happen. Right, assume that it is the case and it is a lady passenger. What is the exemption? What is the exemption? You just first calculate 40 grams. Now 1 lakh is for 50 grams. What will be for 40 grams? 80,000. Or for lady passenger 1 lakh, whichever is. So what is the exemption? 80. What is the exemption? 80. So what will be the taxable value? You have got jewelry worth 1 lakh. What is the exemption? 80. So what will be taxable? On this 20,000 you will pay customs duty at 38.5. Do not forget conversion. First convert it, compare it, find the exemption, then separate it from the actual value that you have paid. Clear? Clear? So what is the exemption limit? For a lady passenger, 40 grams of 1 lakh, whichever is lower. For a gentleman, it is 20 grams, it is half rather. 20 grams of 50,000, whichever is lower. Whichever is lower. This is in addition to your rule 3 and rule 4. Just like rule 6, it is in addition to rule 3 or rule 4. Now, what are the other definitions which are given? Baggage includes unaccompanied baggage, but does not includes motor vehicle. We have already understood that it does not include motor vehicle. We have understood the meaning of resident. A person who is having a valid passport. Personal effects means the items that are required for you for your daily necessities. Personal effects. Personal effects. Because in rule 6 we are going to see something called as household effects. Here it is personal effects for your day-to-day needs. The items are required, that we call it as personal effects. Personal effects. Now, talking about the last computation rule, which is rule 6. Which is your rule 6. So, when you talk about your rule 6, it talks about which situation? It is talking about a scenario where you are transferring your residence. That is transfer of residence. Free allowance to a person who was engaged in a profession abroad, or he was settled in abroad and for some reason is coming back to India. Coming back to India permanently. He is coming back to India. Don't you think that when a person is there outside India for a very long time and coming back to India, he should be getting more exemption? He should be getting more exemption. Just like your rule 5. Rule 6 is also in addition to rule 3 and it is actually rule 3 plus rule 4, rule 3 or rule 4 plus rule 5 plus rule 6 plus rule 5 plus rule 6. These two rules are additional rules. They are extra exemption. They are not replacing rule 3, rule 4. They are extra exemption. Now, when you talk about your state, as simple as that, understand the logic of rule 6. The more you have stayed outside India, the more will be the exemption. The more you have stayed outside India, the more will be the exemption. If your stay outside India was lesser than 3 months, no exemption in rule 6. No exemption in rule 6. So if your stay outside India was 0 to 3 months, no exemption. 6 months to 3 months to 6 months. More than 3 months, but up to 6 months. More than 6 months in last 1 year. More than 6 months in last 1 year. And finally, more than 1 year during some point, right? During last 3 years. More than 1 year during last 2 preceding years. During last 2 preceding years. And finally, minimum 2 years. Now understand this. If it is 0 to 3, 0. 3 to 6, 60,000. 6 months to 1 year, 1 lakh. Minimum 1 year stay in last 2 years, 2 lakhs. More than 2 years, 5 lakhs. So last case you have to remember. But all the other cases it is very simple. 0 to 3, 0. 3 to 6, now always second digits, 60,000. 6 months to 1 year, 1 lakh. Minimum 1 year in last 2 years, 2 lakhs. More than 2 years, 5 lakhs. More than 2 years, 5 lakhs. This is an extra exemption that you get. So, that is a very simple way to remember your amount limit. Now, what amount exactly is that? What is the concept therein? In all the cases, there is a common condition that you are talking about Indian passenger, except in the last case where you are talking about any passenger. Basically, the focus is on Indian passenger. Indian passenger. Now, what items that benefit is that? Be it 60,000 or 1 lakh or 2 lakh or 5 lakh. For what? For what? For personal or household effects, used or unused, not including Annexure 1 items, Annexure 2 items, but including Annexure 3 items. I repeat, this time they have added personal effects as well as household effects. Personal effects as well as household effects. Household effects is not for your personal use, it is for common use of your family. Common use for your family. Used or unused. Not including Annexure 1 items and Annexure 2 items. Annexure 1 benefit is not given anywhere. But including Annexure 3 items. Annexure 3 household effects. Annexure 3 household effects. Then remember the limit 60,000, 1 lakh, 2 lakh and 5 lakh. Now please understand. If it is used personal effects, you will never touch rule 6 because you have unlimited exemption in rule 3, rule 4. If it is new personal effects, new items, you will use both rule 3 and try to plan even in rule 6 if at all there is a limit available. Household effects, whether used or unused, the only place where you can take the benefit is rule 6. Right? Be very clear with it. So you are talking about personal effects as well as household effects. Let us categorize that into old, new, old and new. Now if you are talking about personal effects, if it is used, old, you will always go and take the benefit of under rule 3 because there is unlimited exemption. personal effects which are new, you will try, first you will try taking the benefit under rule 3. If not, and if there is a balance exemption left over in rule 6, you will try to use rule 6 as well. That is a possibility. But household effects, whether it is old or new, it is only rule 6. It is only rule 6. You can do planning. You can do planning. Right. So if you remember this, you see the question, you get to know that, okay, where I have to use it. But remember, when you are doing planning, one item cannot be split. One item cannot be split. That particular item value, supposing it is 60,000, you can keep it either under rule 3 or rule 6. You cannot tell, okay, left over 10,000 is there. No, that cannot be done. Now, talking about extra condition in last two cases. What are the higher exemption in this entire rule 6? 2 lakhs and 5 lakhs. For 2 lakhs and 5 lakhs, they have this extra condition that you should not be using this concession once in, I mean, you should be using this concession only once in 3 years. Only once in, this is there for your 2 lakhs and this is there even for your 5 lakhs. The benefit of 2 lakhs and 5 lakhs is only once in 3 years. Once in 3 years. This benefit of higher exemption of 2 lakhs and 5 lakhs can be taken only once in 3 years. Once in 3 years. It may be possible that you are eligible. I'll tell an example. You went to USA for 1.5 years. You came back. 1.5 years means you are covered with 2 lakhs. You enjoyed the benefit of 2 lakhs. Immediately after 3 months, you went back to, say, Germany. Then in Germany, you stayed there for another 1 year. You're coming back. If you see the entire back time, you have gone to USA 1.5 years, then stayed in India 3 months and again gone to Germany for 1 year and came back. Second time, technically speaking, you are again eligible for 2 lakhs exemption, but you will not get. You have to go with 1 lakh. You have to go with 1 lakh. Once in 3 years only, you will get the benefit of 2 lakhs and 5 lakhs. 2 lakhs and 5 lakhs. For 5 lakhs, there are extra condition. What is the criteria for 5 lakhs, by the way? Your minimum stay should be 2 years abroad. And they have an extra condition that during the last few years, your stay in India should not exceed 6 months. So during your last 2 years, your stay in India should not be more than 6 months. Should not be more than. So you have to remember both. Your stay outside India is more than 2 years. Your stay in India during last 2 years is not more than 6 months. But understand, at times, you may not fulfill both. I'll give you an example. Your stay outside USA was more than 10 years. But during last 2 years, you are in a dilemma whether to permanently come back to India because of your family situation. So you kept coming to India, stayed in India, went back, stayed in India, went back. Which means if you see the last 2 years, 1 year, 6 months you are there in India. 1 year, 6 months you are there in. But your total stay outside India was 10 years. Now don't you think that you are violating this condition? So they give a relaxation. They tell that, okay, principal commissioner or commissioner may consider this and understand that why you stayed in India for more than 6 months in last 2 years because of your family situation, and this may be ignored. Why? Your total stay in US was 10 years. Because of the family situation, during the last 2 years, it happened that you stayed in India for more than 6 months. Another classic example is COVID. COVID can be a classic case. During COVID, you are not sure that you have to be permanently coming to India or not. So you came to India and you settled here for say 1.5 years. You are working from home. Work from home option was given to you. But finally you decided that you will quit the job in US and you will start something of your own in India. So your stay in USA would have been more than 10 years. But if you see the last 2 years, your stay in India was more than 6 months. Don't you think that because of your stay in USA for more than 10 years, when you bring back, you will bring back a lot of items? You require a more exemption limit. Don't you think that you are still eligible for 5 lakhs? Yes. Make an application to Commissioner, Principal Commissioner of Customs, and tell him the situation. He'll relax that condition. He'll relax that condition. What is the main condition here for 5 lakhs? Your stay outside India should be more than 2 years. At times, you will be almost touching 2 years. Almost touching. So, this almost touching 2 years, I call it as 22 months to 24 months. Almost touching. So, you stay in US, say 23 months. Technically speaking, you are eligible for 2 lakhs or 5 lakhs. Your stay in US is 23 months. Technically speaking, you are eligible for 2 lakhs or 5 lakhs. 2 lakhs. But don't you feel that you are feeling a lot? Because you have almost touched 2 years. So what you can do for shortfall up to 2 months, you can make a application to not a higher officer, lower officer, AC, DC, and tell him that please ignore the shortfall of 2 months and give me the benefit of 5 lakhs. Give me the benefit of 5 lakhs. Both are different. What are the two criteria, sir? Your stay outside India should be more than 2 years. And your stay in India during the last 2 years should be less than 6 months. If your stay in India during the last 2 years is more than 6 months, it can be relaxed by Commissioner, Principal Commissioner, because your total stay in US was already more than 2 years. It can be relaxed. But if your stay in US itself is not touching 2 years, but it is almost touching 2 years, what is that? 22 to 24 months. 22 to 24 months. Technically, you are eligible for 2 lakhs, but if you request ACDC and if he is convinced, he can make it 5 lakhs. He can make it 5 lakhs. So that is all about your rule 6. Rule 6. Remember, 0 to 3, 0. 3 to 6, 60,000. 6 to 1 year, 1 lakh. 1 year, minimum 1 year during last 2 years, it is not 1 to 2. Minimum 1 year during your last 2 years, 2 lakhs. More than 2 years, 5 lakhs. More than 2 years. In all the cases, the condition is Indian passenger, except in the last case, any passenger. In the last 2 cases, higher exemption, that is the condition which cannot be relaxed. Which cannot be, the benefit of 2 lakhs and 5 lakhs is only once in 3 years. And there are 2 extra conditions and with relaxation that we have discussed for 5 lakhs. So that is all about your rule 6. And when you talk about time pass rules 7, 8 and 9, not so important. They are all basic time pass rules. 7 tells that customs officer has got powers to even check your foreign currency in terms of your FEMA. There is no collection of duty on your foreign currency. He can ask and check your foreign currency whether you are carrying foreign currency within the limits of FEMA. That is rule 7. Rule 8. Rule 8 basically tells that the benefit of all the exemption 3, 4, 5, 6 is only for accompanied baggage. It is not for unaccompanied baggage. It is not for unaccompanied baggage. But it gives them relaxation. It gives a relaxation. What relaxation it gives? If at all your unaccompanied baggage lands in India up to 2 months before the arrival of passenger, which means first baggage, then passenger. First baggage, then passenger. But the time gap is only 2 months plus extension, not exceeding 1 year. Not exceeding 1 year. Which means, though it is technically unaccompanied baggage, but it came soon. First you have sent the baggage, then you came back soon. See, at times, because of the charges charged by the airline, you have to plan. You will send your baggage, then you will come. So they understand this difficulty and they tell that, okay, we'll be giving you baggage exemption in rule 3, 4, 5 and 6. We'll give you. Rather, technically 5 will not do this. Jewelry will carry. But rule 3, 4 and 6, we will still give you. Because it is understandable. You had sent your baggage and you came immediately within 2 months. If at all it is extension, take permission of ACDC, but total time limit should not exceed 1 year. Now, ulta case, reverse case. First, passenger, then baggage. Now, your unaccompanied baggage is dispatched within 1 month of arrival in India. 1 month of arrival in India. Passenger has arrived. Passenger has arrived. Baggage is coming within 1 month. Obviously, they talk about extension, but there's no upper limit. There's no upper limit. First baggage, then passenger. 2 months plus extension, not more than 1 year. Totally not more than 1 year. First passenger, then baggage. It should come within 1 month plus extension. 1 month plus extension can be asked for any reason. The reasons are given below, not important. You can ask for any reasons. You can explain and tell the reasons. Now, time pass, the last of the time pass rules is rule 9, which tells that baggage exemption will not be given to crew members. We will not give baggage exemption to the crew members except at the time of final payoff on termination, which means except at the time of the last travel, which means if I am talking about a crew member, I have resigned that airline or the shipping line, I am coming along with that same airline or the shipping line. At that point of time, I am technically not the crew member, I am technically the passenger. At that point of time, I can take the relaxation. At that point of time, I can take the relaxation because I am more of a passenger than the crew member. I may be still employee, but I am about to leave that job. But during other times, they can get a petty exemption of 1,500 for what all nonsense items, chocolates, cheese, cosmetics, other petty gifts for themselves or their family members. So every time when the crew member goes outside and comes in, they can bring small items up to 1,500. 1,500. Any item. It need not be chocolate. I don't know why they have mentioned cheese. It need not be chocolate, cheese or cosmetics. It can be any gifts. It can be any gifts for themselves or their family member. Right. So you're talking about your time pass rules being 7, 8, 9. What are the main rules? 3, 4 plus 5 plus 6. Now, if you have seen your baggage rules, you'll find that you don't get any exemption for Annexure 1. You don't get any exemption for Annexure 1 items. There is no exemption for your Annexure 1 items in any of the rules. What is Annexure 1 items? Firearms, cartridges of firearms exceeding 50. Exceeding 50. Gold, silver in any form other than ornaments. Bullion. Rather, bullion is a challenged item. Normal people cannot bring bullion. It is to be brought only by notified banks or the government undertakings. MMTC, Mineral and Metal Trading Corporation of India, or notified banks including your State Bank of India, only they can bring bullion. Don't tell me we have clients there, we know that they are bringing bullions. Physically, they will not be showing in the books of accounts. It is all smuggling. Right. So it is gold or ornaments in any forms other than gold or silver in any forms other than ornaments. Ornaments you can bring but not bullion, not the biscuits or not the coins. Cigarettes exceeding 100, more than 100, exceeding 100. Cigars more than 25, or tobacco exceeding 125 grams. Exceeding 125 grams. And comes your alcoholic liquor or wine in excess of 2 liters. In excess of 2 liters. They give a limit. Firearms, cartridges more than 50, cigarettes more than 100, cigars more than 25, tobacco more than 125 grams, liquor in excess of 2 liters. Liquor in excess of 2 liters. Other items, bullion, and you're talking about television, flat panel television. These are all your Annexure 1 items. When you bring these items, few items you can never bring. Bullion you can never bring. Other items, when you bring these items, you have to pay baggage duty. You have to pay baggage duty. You are required to pay. You don't have any exemption. You don't have any exemption. For example, if you bring 3 liters of liquor, 2 liters, you can enjoy the exemption in rule 3 or rule 4. For that excess 1 liter, you may have your leftover exemption. You may have your leftover exemption, but you are required to pay duty. You are required to pay duty. And out of these items, firearms, cartridges, cigarettes, they will not have 38.5 percentage. They will have their own rate, including goods which are imported by courier. They will not have 38.5. They will have their respective rates. They will have their respective rates for firearms, cartridges, cigarettes and tobacco items. They will have their respective, but liquor, if it is in excess of 2 liters, that excess 1 liter, you will have 38.5 percentage. You will have 38.5 percentage. You will have 38.5 percentage. If it is cigarettes within 100, enjoy rule 3, rule 4. Enjoy rule 3, rule 4. Only if it is more than 100, that's a problem. And that too, you can tell that for 100, I will still enjoy rule 3, rule 4, rule excess, you cannot enjoy. And that excess portion for, tobacco items or cartridges or firearms, always understand that customs baggage rate is not applicable for them. 38.5% is not applicable for them. They will have their respective rate. So always you will find that ICAE will never test the questions which includes firearms, cartridges, cigarettes. It will ask question, it has asked a number of times a question which includes alcoholic liquor. Alcoholic liquor, but not these items. But not these. What about television? Flat panel television? Assume that you went to USA and you went to China and brought only flat panel television. You got nothing else. You have your leftover baggage exemption of 50,000. You cannot use it. You have to pay on the full value of flat panel television at 38.5. All other items will attract 38.5 percentage. Right. This is Annexure 1 items. Annexure 2 and Annexure 3 you go through yourself. Just remember this. Annexure 2 is called as posh household effects. Posh household effects. You don't get the benefit of rule 6. Both are only talking about household effects. Annexure 2 posh household effects. You don't get the benefit of baggage exemption. You will end up paying 38.5 percentage always. Annexure 3 essential household effects. You can enjoy the exemption under rule 6. You can enjoy the exemption under rule 6. And if it is crossing the exemption limit, then 38.5 percentage. Annexure 1 items. Baggage exemption is not at all allowed, be it rule 3 or rule 4 or rule 5 or rule 6. Either you will end up paying 38.5 percentage or respective rate in the case of firearms, cartridges and cigarettes. Annexure 2. It is only for household effect. Annexure 2 covers only household effects. Forget about rule 3. So even in Annexure 2 items, you will not get any baggage exemption. Technically, it has got nothing to do with rule 3, rule 4. It has got nothing to do with rule 6. It had to do with it has got nothing to do with rule 5. It has to do something with rule 6, but you cannot take the benefit. You will end up paying 38.5 percentage. And Annexure 3, you can go for baggage exemption. It has got nothing to do with rule 3, rule 4. It has got nothing to do with rule 5. Can you enjoy rule 6 now? Yes. If it is up to the limit, nothing. If it is more than the limit, if it is up to the limit, don't pay. If it is more than the limit, pay 38.5 percentage. Now, one point I have missed out, which is a very important point. Apart from the exemption that we have discussed, there is an extra exemption for a single laptop. If at all you are bringing one laptop, if you are an adult, two conditions. You are a passenger, not a crew member, and you are an adult more than 18 years of age, then there is an extra exemption apart from rule 3, rule 4. Extra exemption. Extra, which means you do not use the limit of rule 3, rule 4. One laptop by a passenger being an adult There is an extra exemption. There is an extra exemption, which means you are not going to waste your limit of rule 3 or rule 4 or rule 6. You will have an extra exemption. You will have an extra exemption. And when you talk about a passenger, supposing I am the passenger who is going in an international flight, but my travel is only from Coimbatore to Mumbai. The same flight from Mumbai is going to go to London. Whether I will be giving any declaration form? No. Why? I am traveling only in the domestic leg of the international flight. Domestic leg of the international flight. So I am not required to give any baggage declaration because I am only traveling in the domestic leg of the international flight. And finally, please understand that if at all you have valuation issues in valuing your baggage, valuation rules will be clearly applicable. Valuation rules will be clearly applicable. If at all you find any difficulty in valuing your baggage, your valuation rules are applicable for all the goods including baggage. All the rules including baggage. And specifically when you are talking about your rule 3, rule 4, pooling is not allowed. Pooling is not allowed. I have already said this entirely. One item, one person. Another item, another person. You cannot tell that I have leftover exemption, I will transfer to the other person. Right? Pooling is not allowed. If I am coming along with my friend from USA, for both of us it is 50,000 exemption and 50,000 exemption. I have got an item worth 30,000, my friend has got an item worth 60,000. I have exemption leftover of 20,000. I cannot do anything. My friend has used the full exemption, he has got balance 10,000 on which he has to pay duty. On which he has to pay duty. He cannot, my unused exemption, I cannot transfer to my friend. Pooling is not allowed. Pooling is not allowed. That is not permissible when you are going for your baggage rules. And by the way, I say ask questions where you are talking about Mr. and Mrs. spouse, both husband and wife are given and they will give you all the data. You have to plan. And you have to plan in such a way where the tax liability is minimum. Planning is allowed. Pooling is not allowed. You can plan which item to be shown by whom. Which item to be shown by whom. Assume my and my friend have gone outside India and my friend has got goods worth 90,000, 40,000 and 50,000. Two items. If it is one item, nothing. Two items, 40,000 and 50,000. I have not got anything. When I come back, we can plan. I can show that 40,000 item under my name. Take the exemption. My friend can show that 50,000 item under his name. That planning is allowed. That planning is allowed. Pooling is not allowed. So that's all about your baggage chapter. Now talking about your duty drawback, the provisions of your duty drawback are section 74 duty drawback, section 75 duty drawback, read along with common provisions, section 75A which is interest on duty drawback, and section 76 which is prohibition on duty drawback. How many types of duty drawback are there? Two. 74 and 75. 75A and 76 are common provisions for both 74 duty drawback and 75 duty drawback. 74 duty drawback, remember it as traders duty drawback. Remember that as traders duty drawback. You import something, don't do anything, export. Don't do anything, export. So section 74 duty drawback, you have imported the goods, paid the duty, exported as such without being used or after use. See, this not doing anything has got nothing to do with use or after use. You import an item, you don't work on that item. You don't process that item or you don't manufacture that item. You may have used it or you may have not used it. Import it, no processing, export it. In the meanwhile, when the goods were in India, you might have used it, you might not have used it. You might not have used it. So that is section 74 duty drawback. Now section 75 duty drawback. You import an item, do some processing. That processing may amount to manufacture, may not amount to manufacture. It may amount to manufacture, it may not amount to manufacture. Simple example, I import fabric, I export fabric, section 74. I import fabric, do coloring, export colored fabric, section 75. Though there is no manufacturing, but there is a processing. I import fabric, convert into shirt, manufacturing. Now this processing amounts to manufacture. I export it, section 75. The moment I do any process, I work on that item, that process may or may not amount to manufacture. I am covered by section 75. So I import item during the process which may or may not amount to manufacture. Don't you think that I will be using even domestic goods? I may have imported the fabric, but color may have been procured from within India. Dyeing may be from within India. The buttons and threads, if I am converting to shirt, from maybe one within India. So imported goods are the main goods, but other domestic goods are also there. Using both imported goods and few domestic goods, I did a process which may or may not amount to manufacture. There was a final product which was ready. What was exported? Final product is exported. Final product is exported. Bring fabric, send fabric as such, 74. Bring fabric, dyeing or coloring, send dyeing or colored fabric, 75. Bring fabric, convert that into shirt, send shirt, it is 75. 75. Now, in section 74, there are two types of duty drawback. One is section 74(1) duty drawback. Without use, I import an item, I don't use it, I export. One is section 74(2). I import an item, I use it, I don't process it, I use it, I export. Section 74(2). So how many duty drawbacks are there in section 74(2)? Without usage, after usage. Without usage, in section 75, I have three types of drawback. One called as AIR, which is the main drawback, all industry rate. Other called as BR, brand rate. And the last called as SBR, special brand rate. We'll discuss about them. All these 2 plus 3 drawbacks, we'll discuss about them. But understand that in 74, two types. Without use, after use. In 75, three types. AIR, BR, SBR. AIR, BR, SBR. Now, in section 74, I get the duty drawback only of customs duty, BCD, SWS, IGST, compensation cess, even special import duty. If I have paid special import duty, when I export, I will get the drawback even of special import duty. But I don't get the duty drawback of excise duty. Why? There was no domestic purchase. Import from outside India, export to outside India. Nothing to do with India. Whereas in section 75, I'll get duty drawback of customs duty as well as excise duty. Why? Every manufacturing industry requires petroleum products, and petroleum products attracts, and your petroleum product attracts excise duty. Correct. I'll get the duty drawback of customs duty as well as excise duty. But when I get the duty drawback of customs duty, I'll get the duty drawback of BCD, SWS and special import duty. I will not get the duty drawback of IGST and compensation cess. IGST and compensation cess I will not get, with a simple understanding. When I am under section 75, I am doing a process, which means I am a businessman, which means I will be eligible for credit, which means I will be eligible for. In section 74, I may be a businessman, I may not be a businessman. But in section 75, for sure, I am a businessman. I will be getting the credit. So that IGST and compensation says drawback will not be given, because I would have taken the input tax credit. I would have taken the input tax credit. Now, what are the rules for section 74? For section 74, the rules are re-export of imported goods, rules 1995. The name itself is very clear. If you have understood what is section 74, you import and re-export. So, re-export of the same imported goods. So, re-export of imported goods, rules 1995. Section 75. It is customs, central excise duties, drawback rules 2013. What are the drawbacks that you will get in section 75? Not only of customs duty other than IGST and compensation cess, but also of excise duty. So what is the name? Customs, Central Excise Duties, Drawback Rules 2017. Drawback Rules 2017. Now, what will be the type of, what is export in terms of section 74? As well as section 75. Export means India to outside India. India to outside India. Export includes supply of stores to foreign going vessel or aircraft. If I am supplying the stores to foreign going vessel or aircraft, I will be getting the benefit of duty drawback. Technically, it may not be export, but for the purposes of duty drawback, it is called as export. Supply of stores to foreign going vessel or aircraft. Supply of stores to a foreign going vessel or aircraft will be getting the benefit of duty drawback. Whether it is section 74 duty drawback or whether it is section 75 duty drawback. I imported stores, I gave the stores to foreign going vessel aircraft, section 74. I imported the raw materials, I did a process, converted them into finished goods, then gave it to foreign going vessel aircraft as stores, section 75 duty drawback. The meaning of export in duty drawback is extended to supply of goods by domestic tariff to area to special economic zone. Even when DTA is supplying to SEZ, you will be getting the benefit of duty drawback. It is specifically mentioned in section 75. In 74, though it is not specifically mentioned, it is implied. Normally, you will find one thing which is very common in our text, be it our main text, study, revise, crack, or be it our summary text, pure infographics. When something is not there, it will be written and cancelled. It will be written and why go anywhere else? See the previous point. If at all you are talking about a scenario where you are talking about, you will not get the credit of IGST and it was written and striken off to tell you that, remember, don't make this mistake. But you don't find this striking off here for a very simple reason. Though it is specifically mentioned in section 75 that supply of goods by DTA to SEZ will be getting the benefit of duty drawback under section 75, it is implied in terms of Special Economic Zone Act 2005 that this benefit will be there even for section 74. Even if I import something as DTA and I supply to SEZ without doing any process, I'll get section 74 duty drawback benefit. Please remember that point number 2 and 3, technically they are not export. Supply of stores to foreign going vessel aircraft, supply of goods by domestic tariff area to special economic zone. Technically they are not export because export means taking goods outside India to place outside India, correct? Technically they are not export. For normal customs act, they are not export. But for duty drawback purposes, they are export. For duty drawback purposes, yes, they are export. You will be getting the benefit of duty drawback. Now, what are the modes of export that is covered in your section 74? Section 74 covers all the three modes. Commercial exports, which means you are a businessman, or postal exports. Even businessmen will be at times opting for postal exports when samples are sent. Even baggage is covered. What is important is you may not be a businessman. You are just importing an item as a baggage and exporting that as a baggage. So it is covering commercial goods, postal goods, baggage. Commercial cargo, postal goods and baggage. But in section 75, what will be covered? Only commercial exports and postal exports. It will not cover baggage. Why? You are talking about a person who's importing the goods and doing some process. And doing some process cannot be by a person who is calling the item as baggage. Correct? So baggage is not covered there. Baggage is not covered there. Now, what are the conditions for section 74 and conditions for section 75? Section 74 tells that you should have imported the goods, paid import duty and exported the goods, take the benefit of duty drawback. Import the goods, pay import duty, export the goods, take the benefit of duty drawback. What if you have not paid the import duty? No duty drawback. Import an item, pay import duty, export that item, take the benefit of duty drawback. If you have imported an item, if you have never paid any import duty, Beat section 74 or beat section 75. If it is finally proved that you never paid any import duty, you will never get any duty drawback. In section 75, what is happening? You import an item. Along with imported item, you use domestic or indigenous goods. You manufacture a final product and you export that final product. And you export that final product. You import an item, pay import duty, take that item and take the domestic goods or indigenous goods, do processing. It may amount to manufacture, it may not amount to manufacture. After you get the final product, what is exported? The finished goods or the final product is exported. Now, if you have understood this, in section 74, whether identity of goods is important or not important. Section 74, identity is important or not important? Identity is must. Same item is brought and same item is taken back. In section 75, identity cannot be there because you have imported an item, you have done a process, then you have exported it. So, identity may not be it will not be the same. There cannot be any condition of identity being the same. So, you need not prove ACDC with respect to the identity of the goods. That is required in section 74, but not required in section 75. In section 74, duty drawback shall be allowed even if the imported goods are taken for use. What are the two types of section 74 duty drawback? Import, as such, is only one criteria. The same thing in section 74. Without use, after use. I may have imported the item. I have not done any processing. If it is without use, more drawback. After use, less drawback. But in section 75, obviously, if I imported an item, I am going to use that item, convert into finished goods. But after my finished goods are ready, those finished goods should not be used. I imported fabric. Obviously, I'll be converting the fabric into dyed fabric or shirt. They allow it because in section 75, I am doing a processing. But after my finished goods, that is dyed fabric or shirt is ready, I should not use in India. I should not use in India. In section 74, they don't require any value addition because it includes even baggage. They don't require any value addition. They are not interested even in foreign currency. Forget about value addition, forget about foreign currency. They are not even interested if you are bringing any amount. They are not even interested if you are bringing any amount in section 74. Not even interested. Remember that it includes baggage. So when it includes baggage, they cannot put that condition of value addition, bring foreign currency and all. They are not interested in any value addition that you bring. Forget about value addition. They are not interested in foreign currency. Forget about foreign currency. They are not interested even in you bringing any currency. Even if you don't bring anything, you will give you that benefit of section 74. But in section 75, which is mainly for a businessman, what they tell? We are interested in value addition. We are interested in value addition. There should be no negative value addition. Always there should be a positive value addition. At times they will tell that no, it should be positive value addition. It should be more than 20%. So if I have imported for 100, my export price should be more than 100 always. For few items, they may tell that value addition required is 20%. So if I have imported for 100 and export for 110, I will not be eligible for section 75. Why? There is value addition. But for that item, government wants minimum 20% value addition, which I am not fulfilling. I cannot go for section 75 drawback. At times, if nothing is mentioned, make sure that you have value addition. If they specifically tell that they want a particular value addition, achieve that value addition. Achieve that value addition. If nothing is mentioned, if my import price is 100, my export price should be more than 100. If they want minimum 20% value addition, if my import price is 100, I should export it for more than 120. More than 120. Clear? So that is section 75. Wait, that is not the only criteria. When they want this value addition or minimum value addition, at times, value addition is always there. At times they may expect a particular percentage of value addition. Whether it is normal value addition or a particular percentage of value addition for certain goods, you have to bring convertible foreign currency. Initially, they'll trust you and they'll believe that you're going to bring convertible foreign currency. They'll give you the duty drawback. Later on, if you're not able to bring the convertible foreign currency, the duty drawback given will be treated as erroneous drawback and it will be taken back. So that is given here. Now, when you talk about coverage, section 74 talks about duty drawback for all goods. Section 74 is open for all goods. Section 75, in a way it is open for all goods. But for notified goods, you will go for the main drawback AIR. If the goods are not given that, then you will try for BR. Then you will try for brand rate. Section 74, you can take the benefit of Section 74 for all the goods. Section 75, for notified goods, you will go for AIR. If the goods are not notified, if your goods are not notified, you will go for a special drawback called as brand rate. Now, there's a time limit in Section 74. That time limit is when you import the goods, make sure that export is done within 2 years plus extension by CBIC. This 2 years in one case will be 18 months. Normally it is 2 years. We'll be seeing in calculation that in one case it will be 18 months. In one case it will be 18 months. You import the goods, export within 2 years. Normally the time limit is 2 years plus extension by CBIC. But in one particular case it will be not even 2 years. It will be only 18 months. Think of this. Can they have any time limit in Section 75? You import the goods, you do processing, then you export the final product. They have understood that at times you might take some time for processing. At times, even after processing, you will keep the goods for some time. So here you don't have any time limit. Very logical. Because you are importing item, then doing process which may or may not amount to manufacture, then exporting. There's no time limit. In Section 74, you have to file duty drawback claim separately. Rather, this we have already covered when you discuss your refund part. Duty drawback claim has to be filed separately. Even in Section 75, duty drawback claim has to be filed separately. There is only one case where there will be automatic duty drawback. AA. For all industry rate, there will be automatic duty drawback claim. Your shipping bill or bill of export automatically will convert to duty drawback claim once you get let export order. Once you get an order, automatically it will convert to duty drawback claim. In simple language, whether it is Section 74 or 75, you have to make a manual duty. When I tell manual, it does not mean rather I'll change the terms. You have to give a separate duty drawback claim electronically. But what about Section 75 AAR? Automatically, your shipping bill or bill of export after officers passing let export order, automatically it will become your duty drawback claim. You need not give separate duty drawback claim for all industry rate. Now, in Section 75, there's a special point, there's a special restriction where your duty drawback cannot be more than 1/3 of the market price. This we'll see in your calculation part. 1/3 of the, as of now, remember this, 1/3 of the market price of the goods. 1/3 of the market price of the goods. You cannot have your Section 75 duty drawback more than 1/3 of the market price of the goods. Market price of the export goods. Market price of the finished goods which are exported. Now, there are certain common points. What are the common points? If at all, certain common points with respect to your Section 76. If at all your duty drawback claim is very less than 50, you cannot apply for duty drawback. If your duty drawback claim is too much, too high, this is too low. One is too low, one is too high, Your drawback claim is more than the market price of the goods. What is drawback, by the way? Import duty on your imported goods. What are you trying to tell? Your import duty on your imported goods is more than the selling price of the final product. It's too high. It is too high. Clearly, you're doing overvaluation. Clearly, you're doing overvaluation. Rejected. You will not get any drawback. So, if your duty drawback claim is too less, or too high, you will not be allowed to go for duty drawback. At times, your duty drawback will be regulated, which means if government feels that the exported goods are likely to be smuggled back to India, this happens with the neighboring countries, main importantly Nepal and Bhutan. They are likely to be smuggled back. Government has two options. Either tell that sorry, will not give you duty drawback if you are exporting to Nepal, Bhutan, or will give you, but you have to fulfill extra conditions. Give a proof that these goods are actually reaching Nepal, Bhutan, and actually they are being used in business in Nepal, Bhutan. Give us proof. Give us proof. So when you're talking about regulation, if the items are likely to be smuggled back, you will have this particular point. You will have this particular point. These common points are taken from your section 76. And there is one more common point you need to understand. Whether it is section 74 duty drawback or 75 duty drawback, you should be the same person. The person who imported the goods and the person who is exporting the goods should be the, I cannot import the goods and give to someone else and he cannot export and take the duty drawback. The importer and the exporter should be the same person. Should be the same person. Now, that is the main, almost we are done with all the points of duty drawback except the calculation part. The moment you test the calculation part, your duty drawback entirely is over. Now let us see another common provision which we have in a way completed. We will again walk through it, which talks about your interest on duty drawback. Interest on, what is the time for you to make duty drawback claim? Normally in customs, what is the time for you to make refund claim? Normally 1 year. But for duty drawback, 3 plus 3 plus 6. 3 plus 3 plus 6. Good. After you export, 3 plus 3 plus 6. That is the normal time. And what is the time normally in customs for the department to give you refund? Normally 3 years. Normally, 3 months. If not, interest will start. For duty drawback, 1 month. If the duty drawback is not given, within 1 month, your interest will start at 6% per annum from the next date after 1 month till the date of receipt of duty drawback, till the date of payment of duty drawback by the government. Simple. Now, when you talk about erroneous drawback, at times you get drawback which you are not eligible. You get drawback which you are. Don't you think that government will recover it? Government will recover it. When they recover, they will take interest. When they recover, they will take interest. In GST, when assessee is paying government, interest is 18%. In customs, it is 15%. In customs, it is. So you have to pay that drawback. Supposing erroneous drawback is 1 lakh. You return that 1 lakh with interest at 15%. From which date to which date? From the date you receive the erroneous drawback till the date you are repaying it. Till the date you are repaying it. This 2 months has got nothing to do with interest. Don't mix this 2 months with interest. Interest will start from the date you received it till the date you repay it. Then what is this 2 months? If you are not paying this erroneous drawback of 1 lakh with interest at 15% on 1 lakh, from the date you receive the drawback till the date you are repaying the erroneous drawback, within the time of 2 months, within the time limit of 2 months, forceful recovery will happen. Attachments will happen. This 2 months has got nothing to do with interest calculation. It has got nothing to do with. It has got to do with recovery. Interest in case of erroneous drawback will start from where? From the date you receive that erroneous drawback till the date you repay that erroneous drawback. Logical calculation. Then what is this 2 months? If you don't pay that erroneous drawback with interest at 15% per annum, then within 2 months, then they will start attaching your assets. They will start attaching your assets. That is given in section 75 capital A. Section 75 capital A. Now, the moment we have seen this master chart of 74 and 75 and the common provisions, we are almost done with the entire concept of your 74, 75, but for the calculation part. Now, let us see the calculation part of 74. I will be touching only the leftover portion. Whatever is given again is all repeated again. Repetition. We will be touching only the leftover portion, calculation portion. First, we will focus on what? 74 duty drawback. How many types of 74 duty drawback are there? How many types are there? There is section 74.1. There is section 74.2. 74.1, 74.2. 74.1, 1 category. 74.2, 3 categories. What is 74.1? No usage. 74.2, you are exporting after usage. You are exporting after usage. What is the drawback given in section 74.1? 98% of import duty. If you have paid import duty of 1 lakh, you will get 98,000 drawback. You will get 98,000 drawback. And the time limit within which you have to export back is 2 years plus extension by CBSE. 2 years plus extension by CBSE. Now, section 74.2 is after usage. Is after usage. In after usage, you have to be very clear. What are the items? If you are talking about wearing apparel, tea chest, unexposed photographic films, exposed cinematographic films. Wearing apparel, tea chest, unexposed photographic films, X-rays, and exposed cinematographic films. If they are imported and re-exported, when you talk about movies, you will get it and you will again give it back. There is no duty drawback. Duty drawback is equal to 0. Duty drawback is equal to 0. No duty drawback. When you are talking about the second category, what is the second category? Baggage, personal effects. You are talking about second category. In simple terms, you can read it as baggage plus motor vehicles, whether used for personal use or used for business use. Rather, if you see the terms, they have not used the term baggage. What they have used? All goods for. What is meant by all goods for personal use? What is baggage? Personal effects. So this is baggage. Motor cars, personal use or commercial use. Motor cars can never be called as baggage. Baggage definition includes motor vehicles. So what is the second categorization? What is the second categorization? Simple language. Baggage plus motor vehicles. Baggage plus motor vehicles. For this baggage plus motor vehicles, you will have duty drawback where import duty is there minus particular percentage. Subtraction method. We call it as subtraction method. Minus certain percentage. Minus certain percentage. What is that percentage? We'll see. Minus certain percentage. Other items. Other goods which is not covered in first category and second category. Here, duty drawback is equal to import duty multiplied by particular percentage, which is nothing but multiplication method. Which is nothing but multiplication method. It's nothing but your multiplication method. You're talking about your multiplication method. Now please understand that the time limit in the first case there's no time limit because no duty drawback. In the second case the time limit is 2 years plus extension which can be there for another 2 years. The third case time limit is only 18 months. Time limit is only, which means after import you have to export within 18 months. Time limit is only 18 months. Now, what is left out is to understand what is that subtraction method and what is that multiplication method. What is that subtraction method and what is that multiplication method? Which is covered in subtraction method? Baggage, motor vehicles. All other items, multiplication method. All other items. Now, when you talk about your subtraction method for the first year, the subtraction will be 4% per quarter or part thereof. Second year, 3% per quarter or part thereof. Basically, the time limit is only 2 years, but you can go for extension of another 2 years. Third year, 2.5% per quarter or part thereof. And fourth year, 2% per quarter or part thereof. 4, 3, 2.5 and 2 for each year. For the first year quarters, 4%. For the second year quarters, 3%. For the third year quarters, 2.5%. And for the fourth year quarter, 2%. 2%. For every quarter, you will be subtracting it. For every quarter, you will be subtracting it. Now, let us not take numbers as of now. Just remember it. Finally, we will take an example to understand how it works. First year, all the quarters, 4%. How many total quarters are there? 4 quarters. So, total it is 16%. Second year, all the 4 quarters, 3. Third year, all the 4 quarters, 2.5. Fourth year, all the 4 quarters, 2%. That's it. After 4 years, you will not get any duty drawback. 0. Likewise, when you talk about your multiplication method, the lesser you use, the more the duty drawback. Simple. The lesser you have used in India, the more the duty drawback. If it is 0 to 3 months, you will get 95% of duty drawback. If it is 3 to 6 months, 85%. 6 to 9 months, 75%. 9 months to 12 months, 70%. 12 months to 15 months, 65%. And 15 months to 18 months, 60%. It starts at 95. 95 minus 10, 85 minus 10, 75 minus 5, 70 minus 5, 65 minus 5. 2 times separated by 10 and 3 times separated by 5. And remember, it starts at 95 and it ends at 60. It starts at 95, it ends at 60. 0 to 3, 3 to 6, 6 to 9, 9 to 12, 12 to 15, 15 to 18. And we have clearly understood that after 18 months, nothing. The time limit is only 18 months. After 18 months, nothing. You'll get nothing. Right. Now, this is multiplication, which means whatever is the amount, you will multiply it by these percentage. But the problem is how to calculate the quarters or how to calculate the months and from where they will start. Now, we'll understand this with a very simple example, both the parts. Both the path. Assume that in one case you are talking about motor vehicles, in other case you are talking about certain other machineries. So in one case it is subtraction method and in the other case it is multiplication method. You have imported the goods. On 10th April and paid provisional duty. You went for provisional assessment. Final assessment was done on 30th of June. So final assessment was done and final duty was paid on 30th June. 30th June. You gave the goods for export. You filed the shipping bill. On say 3rd of December. 3rd of December. Shipping bill or bill of export. You got let export order on say 7th of December. Let export order. The goods were in India. I mean, what is the time period till which you will calculate the goods were in India? Only when you calculate this time, you can easily calculate subtraction method answer and multiplication method answer. What is the time till which you are trying to tell the goods are in India? From where it will start until where it will end? From where it is going to start? See these are 2 dates for your import and these are 2 dates for your export. You will start your calculation from where? For your import, you will start your calculation from where? 10th of April or 30th of June? 10th of April or 30th of June? It's 10th of April, not 30th of June. The moment you have paid provisional duty, you got the goods. The goods are with you. The goods were with you. The goods were with you. And till when it is the finality that the goods are finally exported? Is it shipping bill of export or let export order? So it is not filing of shipping bill or bill of export, it is let export order. Let export order. Your calculation starts from 10th April to 7th December. One very important point. In customs, quarter is not calendar quarter, it is normal quarter. In customs, quarter is not calendar quarter, it is normal quarter. To make you understand this, I am changing the dates a bit. Just to make you understand this point, I am changing the dates and I am writing this as 3rd of January and 7th of January of the next year. 3rd of Jan and 7th of Jan. 3rd of Jan and 7th of Jan. Just to make you understand the difference. How many quarters are there? How many quarters are there? Tell me the number of quarters and tell me the number of months. For multiplication method, you will require the number of. For multiplication method, you will require the number of months. For subtraction method, you will require the number of quarters. How many quarters? It starts from where? 10th April till 7th Jan. If it was GST, you would have taken us 4 quarters. But in customs, it will be 3, not 4. Mind you, you are going to write the same indirect tax paper where they will test you both with GST and customs. You have to very clearly understand that things are different in GST, things are different in customs. So the quarters are 10th April to 10th July. Then you are starting from 10th April to 10th July. Then 11th July to your 10th October. Then 10th October to, it will end at 10th Jan, which means it is sufficiently within 3 quarters. Within how many months? Months in GST as well as in customs, it is flexible months. There was no concept of calendar month in GST, there is no concept of calendar month even in customs. So, to the extent of months, it is the same. How many months? May, June, July, August, September, October, November, December and Jan. So, how many months? 8 months and few days. Correct? Correct? It is 8 months and 27 days or 28 days. We'll take it as 27 days. 8 months and few days. 8 months and few days. What will be the answer for your motor vehicle which falls under subtraction method? Assuming that import duty paid was 1 lakh. Assuming that import duty paid was 1 lakh. What will be the answer? What will be the duty drawback for motor vehicle subtraction method? 1 lakh subtracted by 1 lakh subtracted by 1 lakh multiplied by how many percentage? As it is only 3 quarters of the first year, it is 12%. What if it was 7 quarters? What if it was 7 quarters? 16 plus 9. 25%. That way you have to calculate. That way you have to calculate. So what will be the answer here? What? 88,000. What if I tell that it is a machinery or a computer system which is not a baggage, which is covered under the last part? What will be your answer here? Multiplication method requires months. It is covered in which slab? 6 to 9 months. It is covered in which slab? 6 to 9 months. For 6 to 9 months, what is the percentage? It is 1 lakh multiplied by 75%. That's it. 75,000. 1 lakh multiplied by 75%. 75,000. So that is the way you have to understand your duty drawback under section 74.1 and section 74.2. We are done with your duty drawback calculation left out portion in section 74.1. Now let us understand your calculation portion in section 75. How many types of duty drawbacks are there in section 75? 3. What are they? What are they? All industry rate, brand rate, special brand rate. All industry rate, brand rate, special brand rate. All industry rate, brand rate and special brand rate. All industry rate, you read it along with rule 3, read along with rule 4, read along with your rule 9. Even 8 is there. 8 talks about validation, which you have already covered. 8 talks about validation, which you have already covered. Brand rate, rule 6. Special brand rate, rule 7. Now, what is your all industry rate? All industry rate is an average rate. They will not check what is the actual import duty that you have paid. Notional basis. They will understand the industry. They'll see how much imports are and how much domestic goods are there. What is the normal import duty which will be there in this industry? They will give you the drawback. Average rate. It is an average rate of import duty in that industry. They will not do calculation in depth. It is an average calculation, approximate calculation. BR, SBR are accurate calculation. But what is simple? Why? AAR is average, at the same time it is automatic. BR is actual. BR is actual and it is not automatic. It is not automatic. You have to make a claim. SBR same way is actual and it is not automatic. You have to make a claim. When you have to make a claim, the time limit for making the claim is 3 plus 3 plus 6. 3 plus 3 plus 6. Right. Here, as it is automatic, there is no time limit. There's no time limit. Another advantage. AIR is documentation free. AIR is without any documentation. BR and SBR is full of documentation. You have to prove, you have to bring the documents. And when you understand the concept of all these points, automatically you understand that in your all industry rate, there can never be any concept of any bond. There's no bond. Whereas in BR and SBR, you have to give a bond if at all you are making a provisional claim. What is this provisional claim? You will tell that, see, lot of documentation are there. It will take time for you to verify. As of now, give me some provisional drawback. And when you are getting provisional drawback, you have to give a bond. And bond is always along with security. Bond is always along with security. Are we clear with this understanding? AIR is average but automatic, no time limit. BR and SBR are actual figures, but they are not automatic. 3 plus 3 plus 6 months. AIR is documentation free without bond. BR and SBR is full of documentation. If at all you have made a provisional drawback claim, if at all you end up making provisional drawback claim, give bond along with security. Give a bond. Give a bond. Are we guys clear with this understanding? Are we guys clear with this understanding? Now, let us understand. We have understood the few principles of AAR, BR, SBR. Not when actually, when AAR will be there and when BR will be there and when SBR will be there. AAR is there only for notified goods. SBR is for, again, same notified goods. BR is there if your goods are not notified. If you don't find your goods notified, you don't have an option, go for BR. You don't have an option, go for BR. So when you talk about BR, you don't have an option. You have to go for BR. But when you talk about SBR, you have an option. You have an option. SBR, you will go, though the goods are notified. Why are you thinking of SBR? Because your actual duty, rather, your drawback under AAR is less than 80% of your actual import duty. You are telling that I am getting very less. I am getting very less. I'll give an example. Supposing import duty and on an item is 1 lakh. Supposing the actual import duty, we'll come back to this particular point. Actual import duty on an item and AAR that you get on an average basis. We'll compare it. Actual import duty on an item is say 1 lakh. Let's say 1 lakh. You're getting all industry rate 1,10,000. You'll be very happy. Average may be more or less. It will never be equal. Either more or less. Average. Your actual import duty is 1 lakh. You're getting only 90,000. In the first case, your actual import duty was 1 lakh. You got 1,10,000. Surely you will opt for AAR. In the second case, your actual import duty is 1 lakh, but how much you are getting? Is it within the tolerance limit of 80%? Is it within the tolerance limit of 80%? Correct. So if it is within the tolerance limit of 80%, what to do? You have to go for AAR. You have to go for AAR. If your actual import duty is 1 lakh, but the all industry rate that you get, the average rate that you get is only 60,000. The average rate that you get is only 60,000. Now, don't you think that your average, based on average rate, you are getting very less compared to the actual import duty burden? Now, you have two options. Either to go for, still resort to AAR, or to go for SBR. People at times still will go for AAR. Why? It is documentation free, easy, automatic. But if an assessee is interested in getting that exact 90,000, what he has to do? He has to go for SBR. He has to go for SBR. So now, if you see this example and come back here, you will understand why things are happening like this. AAR is a normal thing, notified goods. If your goods are not notified, you don't have an option, go for BR. If your goods are notified, but the all industry rate that you are getting, in our example 60,000, is lesser than 80% of actual import duty. What was the tolerance limit? 80%. What is the actual import duty in our example? 1 lakh. What is 80% of 1 lakh? 80,000. Now you are getting only 60,000. It is less than 80%. What will you do? You have an option to go for SBR. Not always. You have an option to go for SBR. So if you go for AAR, there is no need of any bond. If you go for BR, supposing you are making a provisional drawback claim for 1 lakh, you have to give the bond for the entire value of 1 lakh. In SBR, you have to give a bond. You have to give a bond. You are going to give a bond. Supposing provisional SBR you are claiming 1 lakh, but the bond value will not be for the entire value. Let us take the same example. Bond value will be for what? In this third example, please have a focus. I had an option to go for AIR or opt for SBR. Without doing anything, I would have got easily 60,000. I would have got easily 60,000. Now, whether I'll give the bond for the entire value? No. I'll give bond for what value then? I'll give bond for, in this example, 40,000. But if I want to give a formula, I'll give bond for the provisional drawback claim that I'm asking for minus AAR that I would have automatically got. That I would have, if at all my provisional drawback claim that I'm asking for is 1 lakh and AAR that I would have automatically got is 60,000. I'll give bond only for 40,000. My bond value will be only for 40,000. Are you guys clear with this understanding? Are you guys clear with this understanding? That is all about your AIR, BR and SBR. And one common point that we have discussed for all the three, that should be a validation. At times there should be a minimum validation. At times there should be a, now certain special points only for AIR. In your question, AIR can be percentage of FOB or amount per unit or percentage of FOB value is nothing but your export value, or amount per unit, whichever is lesser. So question can give you AAR telling that it is an average value. They tell that more you export, more the duty drawback you get. So they may give AAR rate as percentage of FOB, 20% of FOB. Whatever is your export value, 20% or 10%. Or they may tell that no, will not focus on the export price. Whatever quantity you export, for every quantity 10 rupees drawback will give you. 10 rupees drawback will give you. Or they can tell that, okay, compare both. Take your export value multiplied by say 10% and take your quantity multiplied by say 10 rupees per unit. See both, whichever is less will give you AAR. So the question can give you AIR in any of the format. Either percentage of export FOB value or price per the unit of goods exported or combination of both, whichever is lower. And for AIR, the last part of this entire discussion, they have a cross check. We'll start with the point that we have discussed already. Supposing your all industry rate that you are getting is 1 lakh. All industry rate that you are getting is 1 lakh. Right. But the market price of export goods. Is only 90,000. Now you may ask, sir, how I got all industry rate 1 lakh? Average rate how? It can be percentage of FOB value. When I tell that the market price of the export goods itself is 90,000, how can tax on raw material be 1 lakh? If the selling price of the finished goods is only 90,000, how can tax on raw material be 1 lakh? How? What I did, though the price of the goods was, market price of the export goods was only 90,000, I overvalued it too much. I showed the FOB value of my export goods as 10 lakhs. What is the real worth? What I did? Overvaluation to the extent of 10 lakhs. And in this scenario, it might happen that all industry rate all industry rate might be 10 percentage of FOB value. Therefore, I got this 1 lakh. Got that? Am I doing overvaluation? Yes. Will I be eligible for duty drawback? I am not at all eligible for duty drawback in terms of section 776. Too high duty drawback in terms of section 76. I am not at all eligible for duty drawback. I am a person who's doing fraud, but this is too much fraud. I am not at all eligible for duty drawback. I am aware of this provision. Assume a scenario where I know this provision, I overvalue it. Supposing all industry rate is 1 lakh, but the market price of the goods is 1,20,000. Even seeing the second question, you are very clear that there is overvaluation. Correct? Correct? How can the market price of my finished goods be 1,20,000 and tax portion on my raw material be 1 lakh? Here also there is a clear-cut overvaluation. But 76 will not apply. So what they do? They have a cross-check. Now you will get duty drawback. But there is a cross-check. What is that cross-check? They will tell you, we will give you duty drawback, which is your all industry rate or 1/3 of the market price of export goods. What is your all industry rate that you are calculating? 1 lakh. You have already calculated 10. You have overvalued to the extent of, in this case, the value of the goods was 1,20,000, but you have overvalued to the extent of 10 lakhs. This is also case of overvaluation. Your all industry rate, you are getting it as 1 lakh or 1/3 of the market price. What is the market price? 1,20,000. What is 1/3 of the market price? So how much amount you will get? Whichever is lower, how much amount you will get? You will get the drawback only of 40,000. Though as per AIR it was 1 lakh, but you will get 1 lakh or 1/3 of the market price of the export goods, whichever is lower. You will get only 40,000. You did overvaluation, but you are not able to get the entire 1 lakh duty drawback. You got only 40,000. So why this cross check is not there in BR, SBR? Can anyone just give a reason? BR, SBR is actual. The question of too high or too less will not be there. That too high or too less is there only in AR, because it is not actual, it is average. When it is average, you will try to manipulate. How? Overvaluation of export goods. So this concept is only and only for AIR. This entire principle will never be there for BR and SBR, because BR and SBR is actual duty drawback. With this, we are done with the entire concept of your duty drawback, be it section 74 duty drawback, the 2 calculation part, and section 75 duty drawback, the 3 calculation part, AIR, BR and SBR. Now talking about a very small topic, refund, where we'll be even comparing few numbers of GST as well. Now refund basically in customs is section 27 and 27A. Application for refund and interest on delayed refund. So basically the provisions of refund in customs is 27 and 27A. Then what is 26 and 26A? 26 and 26A are special cases of refund. Normally a case of refund will be covered in 27 and 27A. 26 and 26A is a special case of refund, where you are talking about refund of export duty in a special case, refund of import duty in a special case. So normal scenario is only section 27 read along with 27A. Special scenario is 26 read along with 26A. Now before we see those provisions, let us differentiate your refund with a special refund which is duty drawback. So there's something called as refund and there's something called as a very special refund, technically called as duty drawback. Technically called as duty drawback. Refund, why are you getting the refund? You are paid extra duty, therefore you are getting the refund. Why are you getting duty drawback? It is an export incentive. It means you imported the goods, paid import duty, you are exporting it back. As GST is based entirely on destination based consumption tax, they are giving you export incentive, export benefit, promoting export. So the logic of both is different. So when you talk about your normal refund, it talks about what? You are paid extra, you are asking the refund. That is section 27, read along with 27A, and special cases 26 and 26A. But duty drawback, section 74 and section 75 is because you imported the goods, you paid import duty, now you are exporting the goods, they want to promote export. Whatever duty was paid in India will be given back to you. That is export incentive. In case of refund, you have to make a refund application. In case of duty drawback are of two types, section 74 duty drawback and section 75 duty drawback. 74 and 75. Both in section 74 duty drawback and section 75 duty drawback, you have to submit a duty drawback claim or duty drawback application. But in one case of section 75 in duty drawback, which is all industry rate, section 74, there are two types. Section 75, there are three types. So totally how many duty drawbacks are there? 2 plus 3. Section 74, major two types of duty drawback are 2, 74 and 75. Under 74, there are 2 subcategories. 75, there are 3 subcategories. Out of total 5 subcategories, under 75, there is one subcategory called as all industry rate, average rate, AIR, all industry rate. For that all industry rate, your drawback claim is not required. Automatically you will get the drawback. Refund, it's nothing but a special refund. Automatically you will get a drawback. For what? All industry rate. This all industry rate comes under section 74 or 75? 75. Out of totally 2 categories of 74 and 3 categories of 75, only in one case drawback will be automatic, which is section 75, all industry rate. Now time limit for making refund application, it is 1 year from a relevant date. We'll see what is the relevant date. 1 year from a relevant date. 1 year from a relevant date. Compare with GST, 2 years. Compare with GST, 2 years. In customs, 1 year. In customs, duty drawback is all very fast, very fast. So in AIR, you are not going to make any drawback claim because it is automatic. But in other cases, you are going to make a drawback claim. What is the time limit? 3 plus 3 plus 6. Basic time limit is 3 months plus first 3 months extension on payment of a fees, which is 1% of due drawback claim, or 1000, whichever is lower. Second, 1% of FOB value, or 1000, whichever is lower, not higher, whichever is lower. Maximum fees is for first extension is 1000. Second extension of 6 months, 2% of the FOB value, or 2000, whichever is lower. That will be the minimum fees. Maximum fees in first extension is 1000. Maximum fees in second extension is 2000. So what is the time limit for drawback? Basic time limit is 3 plus 3 plus 3 plus 3 plus 6. 3 plus 3 plus 6. In total, you'll get 1 year. In total, you'll get again 1 year. Now, this will be there only if you are claiming drawback claim separately, which will be there in all the cases of 74 and 75, but not for AIR. This is not applicable for AIR because it is automatic. Once you make a refund claim or a drawback claim, department has to give you the refund or the drawback. What is the time limit for department to give the refund or drawback? Indirectly. There is no direct time limit, indirect time limit. From where interest will start? You have to make a refund application within 1 year in customs, and department has to give you refund within 3 months. If not, interest will start. If not, interest will start. Same. When department is giving you, government is giving you 6% per annum. 6% per annum. Now, drawback is very fast. You have to come very fast. 3 plus 3 plus 6. Officer has to give very fast within 1 month. Within, if not 6% interest. If not 6% interest. So normally you have to apply within 1 year and officer has to give within 3 months. If not, interest. Drawback, you have to apply within 3 months. Extension, forget about it. An officer has to give you within 1 month. If not, interest. If not, now compare this with GST. In GST, when assessee is making refund application is by assessee, refund order is by department. What is the time limit when you talk about your GST? Assessee, 2 years from a relevant date. 2 years from a, in customs, normally it is 1 year from a relevant date. For duty drawback, it is 3 months plus 3 months plus 6 months from the date of export. From the date of export. When officer has to give you an order, it has to give within a particular time. In GST, what is the time? From where interest will start? Indirect time limit for the officer, 61st day, after 60 days. After 60 days of refund application. Refund application. In customs, 3 months of refund application. If not, interest will start. In duty drawback, 1 month from drawback application. If not, interest will start. If not, interest will start. If not, your interest will start. Now, in case of normal refund, your doctrine of unjust enrichment will apply, which means basically you will not get the refund in your pocket. Only if you prove that you have not passed on the burden to the next person, you will get the refund in your pocket. But in case of duty drawback, doctrine of unjust enrichment is not applicable. They will always believe that you have not passed on the burden and always you are going to get the refund in your pocket, drawback in your pocket. When you talk about non-applicability, if the refund amount is less than 100, there's no question of any, no one will apply, it's only theoretical. And if the drawback claim is less than 50, you cannot come. Refund less than 100, not allowed. Drawback less than 50, not allowed. Only theoretical for your exam purposes, not practical. No one is going to do that. Now, that is the basic difference between your refund and drawback. Now, before seeing the normal case of refund, which is section 27 and 27A, let us try to understand your special refund. These special refunds are connected to your levy chapter. They are connected to your levy chapter. First, let us see section 26, where you are talking about refund of export duty in a special case. Normally, refund is never there. Normally, export duty is never there. It is there very, very rarely. Correct? Export duty is very rare. Very rare. So, what has happened? You have sold the goods and there is a sale return. You have sold the goods and there is a sale return. So, there is a sale and there is sale return, which means there is export and there is re-import. This has been discussed elsewhere in levy also. Correct? But this time when you are exporting, you are making the payment of export duty. Normally export duty payment is not that. This time you are making the payment of export duty. When the goods are coming back, what will happen? You need to understand two things. There will be import duty application and there is something about the export duty payment that you have made, that application. What about import duty? Before understanding export part, before understanding section 26, we have already discussed what about import duty. What about import duty? What will be the import duty in case of sale and sale return in terms of notification 45/2017? Lower of actual import duty or export incentives, correct? Whichever is lower. In this case, where you have paid export duty, where you already paid export duty, obviously export incentive will be zero. Export incentive will be, you will not pay any import duty. But in this entire process, don't you think that the goods went and came back? Import duty is not there because notification 45/2017 tells that you have to pay lower of actual import duty or export incentives, whichever is lower. But in this entire process, you have already paid export duty. You will get the refund of export duty also. The goods went outside, they came back, it should be free of any taxes. You have paid export duty, you will get back the export duty. Import duty is never there, there's no question of any getting back. Right? There will be refund of export duty. But what is the condition? The goods should come back within 1 year. The goods should come back within 1 year of exportation. If you see the timeline in your notification 45/2017, they allow the goods to be coming back within 3 years plus 2 years extension. But here, if you want refund of export duty, which is very rare, export duty itself will be very rare. If you want this particular refund, it should have come back within 1 year. So the criteria is the goods should come back within 1 year, and after the goods have come back, you have to make a refund application within 6 months of import. You get back the goods within 1 year. You exported, get back the goods within 1 year. And after they have come back within 1 year, for refund application, condition is get back within, re-import within 1 year, and apply for refund within 6 months. Normally refund time limit is 1 year from a logical date, but special refund the time limit is half 6 months. Special refund the time limit is half 6 months. So that is this entire understanding. What is this entire understanding? It is linked with your levy. Sale and sale return, export and re-import. So on re-import, there will be import duty consequences in terms of your section 20 read along with notification 45/2017, which tells that pay import duty lower of actual import duty or export incentives, whichever is lower. In this case, you will end up paying zero. And in this entire process, when the goods are exported, you have paid export duty. When it is coming back, you can claim the refund of export duty. Condition, bring it back within 1 year. The condition is a bit different. Now not 3 years, bring it back within 1 year. After you export, bring it back within 1 year. And after you bring it back, apply for refund within, normally you have to apply for refund within 1 year, but special case, be it 26 or 26A. In special case, refund application has to be made within 6 months. This is a special case. Your refund application should come within 6 months from the date of, logical date, from the date of re-importation. That is all about your section 26. Refund of export duty in a special case. 26A. Refund of import duty in a special case. Refund of import duty in a, this also is linked to your levy chapter. Refund of import duty in a special case. As an importer, you have imported the goods. Filed the bill of entry for home consumption under section 46, paid the duty and cleared the goods by getting out of charge order under section 47. You have filed a bill of entry for home consumption under section 46, paid the duty, got out of charge order, you took the goods. Please understand that the benefit of section 26A is not applicable when you take the goods to your customs warehouse. This benefit is applicable only when the goods are directly cleared from customs station. This benefit is there only when the goods are directly taken from custom station. From custom station to customs warehouse, then clearing, 26A cannot be applied. 26A is applicable only when the goods are directly taken from custom station, not from customs warehouse. So the duty should have been paid and goods should be cleared directly from customs station. But what is happening? There's a problem with the goods which you did not identify at the time of clearance, and practically 26A will be more logical. You might not know the defect. So once you cleared the goods, you found that the goods are defective or not in conformity with your order, not as per your order. Either they are defective or not as per. See, when I tell the term defective, it can be damaged or deteriorated, correct? The term defective here can be connected to the term that we have discussed earlier, damaged or deteriorated, correct? Correct. Defective includes both damaged and deteriorated. So it is damaged or deteriorated, right? Or not as per your order. If goods are fine, but you have ordered for some other quality and you have received some other quality, it's not as per your order. You find that. So what you have to do? You have to apply for refund of import duty if you do something within 30 days plus 3 months extension. The moment you clear your goods, you have to take an action within 30 days plus 3 months extension. First take an action, then apply for refund. 2 stages. First do something. Do something within what? First take an action within 30 days plus 3 months extension by the commissioner. Then make an application for refund. First take an action, then make a refund application. What action you should take? There are 3 possible actions that you can take within 30 days plus 3 months extension. And when you talk about making a refund application, special refund time limit will be 6 months from the time when you took the action. Now 30 days plus 3 months will be counted from where? From the date when you cleared the goods, when you got the out of charge order. You are required to do what? Either send back the goods, re-export, or relinquish the title and give the title to the Commissioner of Customs. Either send it back or give up the title or destroy the goods in front of the officer and make it commercially valueless. Send it back, relinquish, destruction. You are not required to do all, either or. Either send back within 30 days plus 3 months extension, or relinquish the title within 30 days plus 3 months extension, or destroy or make it commercially valueless in presence of proper officer within 30 days plus 3 months extension from the date of out of charge order. After you do that, you make a refund application within 6 months of a logical date. Tell me, what will be the logical date? If I send back the goods, what will be the logical date? Date of export, late export order. If I have given up the title, what will be the logical date? Date of relinquishment. If I have destroyed the goods or made the goods commercially valueless in front of officer, what will be the logical date? Date of destruction or rendering the goods commercially valueless. 2 step. First take an action, then apply for refund. Take an action within 30 days plus 3 months, then apply for refund within 6 months. Take an action within 30 days plus 3 months from out of charge order date when you got the goods. What action? Re-export, relinquishment, destruction. Then after re-export, relinquishment or destruction, from that time, from late export order under section 51, or from relinquishment of title, or from destruction, from that time within 6 months, make a refund application. Now, certain conditions, we have done this provision, certain things that you need to satisfy. You make sure that the goods that you have brought, you don't use in India other than to find out the defect or non-conformity as per your order. You don't use them. You can use to the extent of finding out the defect or to find out that the goods are not as per your order. Otherwise, you should not use the goods in India. AC/DC should be satisfied that the goods which were brought inside and taken outside are the same. Otherwise, few people at times practically colliding with the officer, what they'll do, they have the goods which are already worthless. They'll import this new goods, pay import duty, having an understanding with ACDC, bring another set of goods, tell that they are not of any use for me. In front of him, destroy. Already they are worthless. In front of him, destroy. What is the advantage you get by this? You'll get the entire import duty refund. So you get the goods in India without import duty. It's not an idea that you have to apply. I'm telling practically this might happen. Therefore, there is a responsibility on ACDC to make sure that the goods are exactly the same what came in and again what are going out. And needless to say, you cannot have two laddus in your hand. One side you are telling that I'll take this refund of import duty. Other side you are again making a drawback claim, which is nothing but refund of import duty. Drawback means what? Refund of, you cannot get two laddus. Rather, which option you'll advise your client? If your client is doing this, you tell that please go for section 26A, don't go for section 74. The corresponding provision here, option here would have been section, not 75. 75 means you are working on. 74 means imported, exported. You will advise your client not to go for section 74. Why? In section 74, the maximum refund that you will get is 98%. But here you will get the entire refund. Entire refund. What is the point that I trying to tell? You cannot take benefit of both. Either it is full refund of import duty or you go for drawback under section 74, which is 98% refund of import duty. Also make sure that refund will not be entertained if at all the goods are perishable goods or have a very short shelf life. The goods are perishable goods and short shelf life, they will tell that no. Because they are perishable, the goods now may have been worthless. So this benefit of 26A will not be allowed for perishable goods or goods which are having short shelf life, or you have committed an offence under any law. You have committed an offence under, you are doing smuggling, you are caught, you paid lesser import duty, now they are taking action against you to collect differential import duty along with interest and penalty plus criminal proceedings. You tell that nothing, I am going to send it back. No, not allowed. Not allowed. If you committed an offence under any law, forget about the benefit. The benefit will not be entertained for a person who has committed an offence under any law, fraud person, under any law, under, not only in the customs law, under any law. So that is section 26A, where you are talking about refund of import duty in a special case. Now what is that special case? You understood. Defective or not as per your order. You have cleared the goods, but you find the goods are defective or not as per your order. Now the normal refund provision is section 27 and interest on refund is section 27A. This is normal refund application. Now what has happened? You have paid excess duty for some reasons. Now you are making a refund claim. So whenever you are making a refund claim, assessee is going to make a refund claim to ACDC. Now whenever he is making a refund claim, he has to give refund application along with documentary evidence. What is the documentary evidence that he has to give? He has to tell that this is a proof that I have paid extra duty and interest, maybe challan or a script or an order copy, plus I have to prove that I have not passed on the burden. Maybe I will tell that initially I passed on the burden, then I reverse it by giving a credit note, or I may get an affidavit from the customer that I have not passed on the burden. CA certificate per se will not be valid. CA certificate is a supporting evidence, not the main evidence. CA certificate can be along with your credit note for reversal of tax against the customer and affidavit of the customer. Credit note to the customer and affidavit of the customer are the primary evidence. CA certificate is a secondary evidence. As already discussed, what is the refund time limit in customs? Whenever you end up paying more duty, be it import duty or export duty along with interest. See, when you are paying more import duty, it can happen you have paid more interest. Correct? You can get the refund of excess duty paid or excess interest paid or both. You have to make a refund application within 1 year from relevant date. What will be relevant date? Relevant date is always a very logical date. Very logical date. You need not buy it, just think of it and you'll get a logical date. Now, relevant date, if at all, you are getting the refund because of a special exemption order under section 25(2), special exemption order, which means it is going to be given only to special assessees, not for all the assessees in the industry. You would have made a special exemption request in April. You will get special exemption order somewhere in December. But that order in December is telling that you are eligible for exemption right from April, retrospectively, right from between April to December you are paying duty. Between April to December you are paying duty. Now suddenly you become eligible for exemption. That means the duty that you have paid, you can claim the refund. The duty that you have paid, you can claim the from which date? From April or from December? 1 year will be calculated from which date? When you got to know that you are eligible for refund? April month or December month? So it is from the date of issuance of such special exemption order under section 25 subsection 2. Or if the duty becomes refundable to you because of a judgment, decree, order or direction of appellate authority, tribunal or court, you are getting the refund because of order of appeals. That order of appeals can come after 10 years. Can come after 10 years. Now, after order of appeals, you are going to make a refund application. Refund application within 1 year. Within 1 year from where? You paid that duty 10 years back. Now, 1 year will be calculated from where? From the date of appeals order. Only today, after you get the appeals order, you get to know that you are eligible for refund. So, from the date of order. Now, understand that technically, if you are getting a refund because of appeals order, technically, you need not even make a refund application. Though they given relevant date, technically speaking, if you get a refund because of an order of appellate authority, tribunal or court, technically speaking, you need not even make a refund application. Officer is bound to give you refund. And normally, when interest will be calculated? In customs? After you make refund application? 3 months. But in this case, technically, you are not required to make any refund application. After the order of appeals, be it appellate authority or tribunal or high court or supreme court, if officer is not giving you the refund within 3 months of order, it is not 3 months of, it is not 3 months of refund application. It is 3 months of order. I am again repeating, technically you need not even make refund application. They have to give you the refund. Within what time? Within 3 months of appeals order. They are bound to follow their order. Why should I go and tell them that give me my refund? They have to give me my refund within that 3 months of appeals order. If not, interest will start. If not, interest will start. So this 3 months, this time, normally 3 months is calculated from refund application. But this time 3 months is calculated from order. Now, if at all it is a case of provisional assessment, we have discussed that in case of provisional assessment, you can pay provisional duty a higher rate, say 20%, and final assessment may be at a lower rate, 10%, which means you have already paid 20, but what you should have paid is only 10. The excess 10% you will get a refund. Now, when you get to know that you are eligible for refund? At the time of provisional assessment or at the time of final assessment? So, you get to know you are eligible for refund only at the time of final assessment, which at times is called as reassessment. So, you are going to calculate that 1 year from the date of final assessment or reassessment. These are all special cases. What is a normal case? If it is not covered in case of special exemption order or appeals order or final assessment order, then normal case. Take a very normal case. By mistake, you have paid something extra. From which date you are going to make refund application? 1 year will be calculated from where? 1 year will be calculated from where? 1 year will be calculated from the date of payment of duty or interest. The moment you tell that you have paid extra, 1 year will be calculated from the date of that excess payment. The date of that excess payment. But in case refund is applied by the buyer of the importer, I have paid extra, I am not applying the refund, I paid extra, I pass on the burden to my customer. Now, can my customer go and apply for refund? Can my customer go and apply for refund? I imported the goods, I paid extra import duty. It was 10%, but I paid 20. I sold the goods to you, I pass on the burden to you. Now, I can apply for refund, no doubts. But can my buyer apply for refund? Yes. Supreme Court in Mafatlal case said the officer, more logical person to go for refund is not this importer, but this buyer. Because finally the burden is shifted to him. So he can always apply for refund. When buyer of import is applying for refund, what is the logical date for him? What will be the logical date for him? It will be 1 year from where? 1 year from the date of, at times you have to do planning. If I have missed my train, I paid import duty in 2022, right? And I sold you the goods somewhere in 2024. I realized that in 2024. Now, if I try to make a refund application, 1 year is gone. 1 year from the date of payment, which is 2022. But I sold you the goods when? 2024. I'll tell you, don't worry. You go. You go. You go now. This is all tax planning. This is not tax evasion or tax avoidance. It's all tax planning. Now you go. You make a refund application within 1 year from the date of your purchase. You have purchased in 2024. From that date or that particular date, you will be taking a particular date. From that date of purchase, you have 1 year time to apply for refund. Apply for refund. There's a concept called as duty paid under protest. For that, this time limit is not at all applicable, 1 year. Why? This is not at all tax. You are telling that I am not ready to pay this tax amount, but to buy peace with the department, I am paying this amount. Department is telling that 20%, 20%, I am fighting that it is 10%, 10%. And I tell that, okay, I am going to fight this case in appeals. Now I am paying this excess 10% under protest. When the final appeals order comes, link this with final appeals order. Link this with final appeals order. When the final appeal order comes, automatically department is bound to give me refund. I need not make any refund application. I have already said this point when I said they have added this point to tell that 1 year will start from that. Logically, I am not at all required to make any refund application. Department has to give me that refund within 3 months of the appeals order. If not, pay that amount with interest. Now, as already discussed, refund will not be entertained if the value is less than 100. If it is duty drawback, value is less than 50. Now, in which all cases I'll get the refund in my hand, or in which all cases the refund will go to Consumer Welfare Fund. By default, the refund will always go in the hands of Consumer Welfare Fund. I will not get the refund in my pocket. If I want the refund in my pocket, if assessee wants a refund in its pocket, it should be proving that the burden is not shifted. The burden is not, but there are certain cases where by default it will be assumed that burden is not shifted. And by default, assessee will get the refund in his pocket. What are those cases? What are those cases? If I have imported the goods as an individual for personal use, nothing but my baggage. Nothing but my baggage. If at all you are talking about export duty as discussed in section 20, special refund of export duty, sale and sale return. Sale and there is no question of shifting the burden because no third person is involved. I sold, I got back. I sold, I got back. So refund will come to my pocket directly. Why in baggage there is no question of doctrine of unjust enrichment? I imported the goods for my personal use. There is no question of shifting the burden because I never sold the goods. Or in case of duty drawback under section 74 or 75, export benefit. Whenever you go for duty drawback, whenever you export the goods, it is always assumed that you export only the price, you don't export the taxes. Export the goods, export the service, not the. It is always assumed that you did not export the taxes, you did not shift the burden, so benefit will come to your pocket. Or you paid extra duty in case of self-assessment, that excess payment is reflected in bill of entry. Before you got the out of charge order, you realize that you have made excess payment. For example, the duty payment was 1 lakh rupees. By mistake, your employee has typed it as 10 lakhs. So that is excess payment of duty paid, which you realize before officer is giving you out of charge order. Which you realize before officer is giving you out of charge order. There are two types of bill of entry: self-assessed bill of entry, reassessed bill of entry. Normally it will be self-assessed bill of entry. If officer is having doubt, he will reassess the bill of entry. In case of self-assessment, that excess duty paid is reflected in your own bill of entry. In your own bill of entry. In case of reassessment, the excess duty payable is reflected in your reassessed bill of entry, which means reassessed bill of entry shows 1 lakh, but you have paid 10 lakhs. But you have paid. Think of this. Out of charge order you have not received. The moment you have not received out of charge order, can you clear the goods? No, you cannot clear the goods. If you have not cleared the goods, is there any possibility that you have shifted the burden? Is there any possibility that you have shifted the burden? No. What is the understanding? You will get the refund in your pocket. You will get the refund in your pocket. In these four cases, other cases you have to prove that you have not shifted the burden. In these four cases, by default, it is believed that you did not pass on the burden and you will get the refund in your pocket. Whether it is baggage or whether it is export duty refund under section 26 or whether it is duty drawback under section 74 or 75 or whether it is excess duty payment which is reflected in your bill of entry, self-assessed or reassessed bill of entry, but out of charge order is not yet passed. You have not yet cleared the goods. In all these four cases, you will get that excess payment of duty in your pocket. Other cases, you have to prove that you did not pass on the burden. If you prove, you will get in your pocket. Otherwise, the amount will go to Consumer Welfare Fund. And with respect to interest, I guess we have already discussed how interest will be calculated. Within how much time department is having, what is the time department is having to give you the refund? There is no direct time limit for department. Indirect time limit is there. If they don't give you the refund within 3 months of refund obligation, they have to pay with interest at 6%, right from the next day of 3 months till the date of actual refund. At times, if refund is because of appeals order, 3 months will be calculated from appeals order, not from the refund application. And they have also clarified that we are not going to give you any interest on your deposits, be it your security deposit or project import deposit. Deposit is the amount that you are giving for our security purposes. On these deposits, we are not going to give you any interest. On the deposits, we are not going to give you any interest. So that is all about this very small topic called as refund.